morning, everyone. Welcome to Yahoo Finance. I'm Brad Smith alongside Shauna Smith. Happy Jobs Friday. It is almost 8:30 a.m. here in New York City. We're just 2 minutes away from that monthly jobs report. Let's run through what we're expecting here very briefly. Non-farm payrolls expected to show a gain of 175,000 jobs for the month of July added. There you're taking a look at the unemployment rate. We're expecting that to stick at about 4.1% year-over-year wage growth. We're looking for that figure to come in at 3.7% here. And then just taking a look at the futures coming into this activity as well here this morning. One of the huge things that investors are really going to be keeping tabs on here is how we see the markets move, especially in the digestion that we've seen of bad news is good news, but ultimately good news. Does that continue to be bad news here? And when do we finally see, at the end of the day, some of the kind of just, I think, calm or normalization here going forward here, Shauna? Yeah,
I think a big thing that investors are going to be closely watching, and economists obviously closely watching, is going to be that unemployment rate. We have seen that unemployment rate tick higher for the past 3 months. Last month, it reached 4.1% in the month of June. It was the highest that we had seen since June of 2021. Now the big question is whether or not we're going to see that tick higher to 4.2%, whether or not the Sahm rule is going to be triggered, and then ultimately what exactly that tells us. And for those of you who aren't too familiar maybe with what the Sahm rule is, it's when the average unemployment rate of the past 3 months is a half of a percentage point above the low of the previous year. Then that signals that a recession is likely. There has been some dismissal. Fed Chair Jay Powell was asked about that during the press conference on Wednesday, saying that this time it's a little bit different when you talk about the dynamics at play within the labor market. But that is going to be one thing that is watched in this report here in just a few seconds.
Absolutely. Futures lower coming into this report. We are just 5 seconds away here, and ultimately we will see exactly where the market hour ahead of the trade begins here.
Okay, taking a look at this report, much weaker than expected. Jobs coming in at 114,000. Again, just to remind you, the estimate on the street was for 175,000 jobs added, so much lower than what the street had been forecasting. Unemployment rate actually ticking higher to 4.3%, a jump of 0.2% on a month-over-month basis. Digging down into some of the average hourly earnings here, figures that we're seeing on a month-over-month basis, it increased by 0.2%. That was a bit lower than what we saw the previous month. On a year-over-year basis, average hourly earnings was up 3.6%. But again, showing material softness within the labor market. That, of course, has been a worry here for the markets, and you can see by the market's reaction to this print. And we really saw a shift, I think, in the sentiment yesterday, where we started to see the markets pricing in bad news for the economy as bad news for the market. We saw that on the heels of the manufacturing print yesterday. Now we're seeing that on the heels of this unemployment print here today. So I think the question is whether or not the Fed has maybe waited a bit too long to cut rates. And of course, that has been the debate now for several weeks.
Yeah, for those wondering at home, also an interesting note within this employment situation, acknowledging Hurricane Beryl. They said, the Bureau of Labor Statistics, that Hurricane Beryl had no discernible effect on the national employment and unemployment data for July. You'll remember that this is the hurricane that made landfall on the central coast of Texas on July 8th, 2024, during the reference periods for both the household and establishment surveys here. The response rates for the two surveys were within the normal ranges, they do note here. So that added note, atypical from what we typically see or from what we normally get in this update, but no doubt apt for the Bureau of Labor Statistics to include that there. But one of the huge things that I'm keeping tabs on as well, sectors here. Employment continued to trend up in healthcare, construction, and in transportation and warehousing, while information actually lost jobs during this most recent reading as well here, as we've been tracking the U.S. futures on your screen right now.
Yeah, we're seeing a bit of selling action here across the board. Jared Blickery is closely tracking this for us. Jared.
Yes, I would mention, though, that the selling had begun already before the report had been released. Here's the Nasdaq. It's down 2.3%. That is not a small amount. And here is the report release time, and you can see ticked just ever so lower here. But I would say that's a pretty muted reaction, historically speaking, to a report like this. You can also see the Dow, and let's take a look at that chart. That's down 1.15%. Took a little bit of a leg lower here, but again, it had already been down by over 1% when the report report dropped. And now let's take a look at the bond market. We have 2-year U.S. Treasury note futures, which move inversely with yield. So we have this big spike up. That means yields on the 2-year maturity, those are ticking down rather quickly and rather heavily. And then we see a very similar situation with the U.S. Treasury, the 10-year as well. We want to check out what's going on in gold. Sometimes we do get some movement there, and you see a little bit of a tick up. But what I think is really interesting about this report, 4.3% on the unemployment rate. That should trigger the Sahm rule by my calculations. In fact, you only needed 4.2%. What that means is, according to that rule, the economy is in recession already, but that might contradict with our everyday experience. And even Claudia Sahm herself has expressed doubt that it would be applicable in a post-pandemic world. But nevertheless, that is a conversation that is going to be had today. Want to check out the sector action. You can see the red background is what happened yesterday. Tech was down quite a bit, almost 4%. And guess what? It is down another 3% in the early goings here. It looks like consumer discretionary, that's almost off about 3%. Materials and financials also flagging. In the number one leadership position, we got utilities and we got staples. The only things in the green are pretty defensive there. And I'll just round out with a look at the Nasdaq. We are in the midst of earnings season and we're still seeing a lot of activity. Amazon down 9%. We're going to be talking about that. Nvidia down 6.5%. Intel is in here somewhere, not looking that good, but we'll be talking about all of that in the minutes to come, guys.
All right, Jared, thanks so much for breaking that down. We want to dig into this report a little bit more. For that, we want to bring in Joe Brusuelas. He's RSM's chief economist. We also have Mark Pinto here with us on set, head of America's equities at Janus Henderson Investors. Thank you so much to you both for joining us here. Mark, let me start with you. When you take a look at this print, materially weaker than what the street had been expecting for this report, and I think going in, one of the real risks or one of the real concerns here from the street is that we were going to see a dramatic drop. So what's your first take on this print?
Well, it's definitely a weaker number than people expected, and the fact that the unemployment rate went up 0.2% is probably not that surprising. I've read estimates that we need 200,000 jobs, new jobs per month, just to keep the unemployment rate stable. So a print in the 114,000 is not surprising, and you know we see reports that the workforce is increasing. So it's going to take more jobs per month to keep that rate steady. But definitely a weaker number, definitely going to raise concerns now that the Fed is, behind the 8 ball, probably increases the probability of 2 rate cuts this year.
Is the Fed behind the 8 ball, do you think?
Well, I mean, if this number is as written and doesn't have any hurricane impact, definitely a weak number. And it's going to raise that concern. I think it still remains to be seen if the Fed's behind. GDP is still admittedly slowing, but still pretty strong. We're seeing pockets of strength in the economy. We're definitely still seeing signs of inflation, but clearly the trend is moving in the other direction.
And you just mentioned that we need 200,000 jobs per month just to keep the unemployment rate stabilized. I just did some quick math with the revisions factored in. Right now, we're averaging about 169, 170,000 jobs over the last 3 months, well, this report included. Once you kind of take that into account, and Joe, I'll kick this one your direction, does this squarely put the September cut on the table for the Fed?
I think this just about guarantees you're going to get a 25 basis point cut. To be honest with you, I think what this does is it puts a September, November, and December cut on the table. I think we can begin talking about the possibility, if not probability, of 75 basis points of cuts this year. Look, the unemployment rate went up to 4.253%. That's going to be scored as a 4.3 because 420,000 additional people entered the labor force. So we want to put this in context. The unemployment rate's not going up necessarily because we've seen a lot of layoffs. It's going up because people are moving back into the labor force to take advantage of that 3.6% increase in overall wages. That's what you want to see as an economy normalizes. So my sense is we're still on track to have an unemployment rate around 4.3% at the end of the year. That's in line at least with my baseline forecast. And the general weakness we saw, and what we want to pay attention to here is that, hiring and professional business services has just slowed to a crawl. You can see that we got a little bit of a disappointment in terms of how many people were hired by the state governments. And leisure and hospitality didn't outperform normally the way you would expect in August. So there's a lot on the table, but I think the primary takeaway is labor market's normalizing. It's below what we think is 150,000 is the break even. If you get numbers below that, you're going to continue to see that unemployment rate increase. And the Fed simply is just going to have to move to cut rates, make that rate less restrictive. And as you, Shana and Brad, as you know, we were one of the ones calling for a July rate cut. They didn't do that, but we'll get it in September.
Joe, what do you think about this talk more and more here? I'm taking a look at the latest numbers coming in. It looks like the rate market now is pricing in that there's a 63% chance of a 50 basis point cut in September. Is that something that you think should be on the table, is on the table?
I think that it's going to be talked about. Look, as an economist, I don't get too wrapped up in market volatility around what the federal funds market says. There's actually a rational argument for hiking by 50 basis points. Is if you think the real neutral interest rate is much higher than what the Fed does, say over 2%, then it would imply that the current federal funds rate is too tight by about 50 basis points. And if the Fed wanted just to go ahead and put the federal funds rate where it should be based on the prevailing rate of growth in the economy, on inflation, there's an argument to be made for cutting by 50 basis points. And we're going to have that over the next 6 weeks.
I see you nodding your head, Mark. What do you think?
Well, I think we probably will see 50, maybe 75 by year end. I think a 50 basis point rate cut, though, could potentially send some shockwaves through the markets. I think would help underscore the argument that the Fed's behind. So I could see them doing it maybe in stages, but I think 50 could be sending a pretty strong message to the market that may not be received that well.
Mark, the cost of being late, I think when you take a look at now with that 4.3% in unemployment rate right now, the Sahm rule has been triggered. We are a half of a percentage basis point here higher than we were a year ago. Does that signal a recession? Or I guess when we talk about the chance here that the Fed was late, what does the cost maybe of being late look like?
Well, I think, you know, at Janus Henderson, we've been saying that we see a soft landing in the cards. But clearly a soft landing is you're threading a pretty thin needle. So clearly now we're a little bit on the side of maybe closer to a hard landing, but I think we're still pretty confident that we're going to see a soft landing, but clearly this is going to raise some concerns. And you know, I think, look, obviously interest rates are a key driver of the economy and the markets, but you know, we also look at CEO confidence, anecdotal information from the companies that you know we're invested in, and you know definitely seeing some signs of weakness, but we're also seeing a lot of signs of strength. And as active investors, you know we focus on sectors and areas where we see companies that can buck the trends.
Joe, just lastly, you know, we were taking a look across all of those readings on the screen a moment ago. I mean, it was a miss on every single category here, and so that considered, when does bad news actually start to become bad news, and the markets have to price that in as such?
Well, you would need to see the hard data fall off the cliff, and that's just not what's happening. We got an overreaction, in my opinion, to an ISM report. We're going to get the ISM services. That's really what this economy is about on Monday. We'll see where we go with that. Look, one thing on the Sahm rule, we want to be real careful around that. That's a rule of thumb that, in my estimation, probably is not going to survive the pandemic era shocks. My math over how you calculate the 3-month moving average over the past 12 months, it needed to be 4.26. We only got to 4.253. So it's important that we don't hyperventilate over that and begin loose and undisciplined talk around a recession. Look, through the end of June, the economy excluding trade, inventory, and government, and I want to emphasize government because government plays a big role in the economy these days, expanded at 2.6% rate. Economy's not in recession. Hiring's just slowing, in my opinion, because we've been holding on to employees, probably too many employees, for a long time. We're not laying them off. We're just not hiring as many as we once were. Moreover, the increase in that unemployment rate had more to do with people entering the workforce. 420,000 individuals entered the workforce in July. That's what caused that to go up. From a policymaker perspective, that easily could be interpreted as a virtuous increase. in the labor force, because we are still short labor in this country, and we will be short labor for the indefinite future.
Joe, you know, the only things that make me hyperventilate is to see so many MLB teams catch up to the Phillies record right now. Joe Brusuelas, who is the RSM chief economist, and Mark Pinto, who is the head of America's equities at Janus Henderson Investors. Gentlemen, thanks so much for taking the time here this morning.
Thank you.
Thanks. Everyone, just to recap the numbers here, as we are a little over an hour outside of the start of today's trading activity, actually inside of an hour here, taking a look at the non-farm payrolls that came in at 114,000 jobs added during the month of July versus the 175,000 that was expected. The unemployment rate ticked higher, came in at 4.3%, well above what the estimate was of about 4.1% there. And then the average hourly earnings, this is the year-over-year figure, that came in at 3.6% versus the expectation of 3.7%. The month-over-month reading for those who are keeping tabs at home as well, that came in at 0.2% versus the 0.3% that was expected. Stock futures, as of right now, they were moving to the downside. We will be right back with more analysis on what this report means for some of your favorite stocks. Don't go anywhere.
A weak jobs report sending stocks lower here this morning. 114,000 jobs were added to the U.S. economy in the month of July. That was much lower than what the street had been expecting at 175,000. Taking a look at the market's reaction to this, we're seeing a sell-off underway here in the pre-market. You've got futures across the board trading lower here. This is just the latest econ data print that is disappointing here to the markets, and we're seeing some selling action as a result. Well, we've got team coverage here to break down what we're seeing on a sector basis. Our very own Brooke DePalma, Madison Mills, and Ines Ferre are tracking some of that movement. Brooke, let's start with you.
Yeah, good morning, Shauna. Once again, healthcare, one of the biggest gainers in this month's job report, really coming back from the COVID-19 pandemic. Healthcare has been and continues to be one of the strongest gainers here. As you can see on the screen, the sector did add 55,000 jobs in July. That's similar to the average monthly gain over the past 12 months of 63,000. And it is higher than what we saw back in June when the healthcare sector added 49,000 jobs. Taking a deeper dive within the sector, home healthcare services did add 22,000 jobs. That's ambulatory care services. We've seen more people seeking care outside the hospital. That continues to be gaining within the sector. Hospitals added 20,000 jobs, and nursing and residential care facilities added 9,000 jobs in the month of July. Now, the average hourly wage for both private education and healthcare services did see a bit of an uptick from $34.18 to $34.26 last month. Inez, I know that you're standing by the big board to take a closer look at another gainer, construction. Inez?
Yeah, that's right, Brooke. Construction added more than 25,000 jobs in July. That came in line with the average monthly gain of over the prior 12 months of roughly 19,000. Specialty trade contractors. These are typically contractors responsible for the completion of a specific job. It can be an addition, a repair, a maintenance. Those jobs were up. And seasonality does play a role here. That could be part of the reason why you are seeing that the summer months being taken advantage of by employers. In fact, if you take a look from May to July, seasonally, there has been a month-over-month increase from 11,000 in May, steadily increasing to that 25,000 number that we have seen in July. This is a sector that has also a large labor gap issue, not enough skilled workers. And remember, a lot of the construction that we are also talking about has to do with industrial construction, onshoring taking place, infrastructure, data centers, all of that, not just residential, guys. Madison, you are watching transportation and warehousing.
That's right. Taking a look at transportation and warehousing, one of those top three sectors in terms of jobs added. In the month of July, 14,000 jobs added as employment continued to trend up in this area. You can see on your screen here, 11,000 couriers and messengers added over the month and 11,000 in warehousing and storage. Now, these gains, I should mention, were partially offset by a loss in transit and ground passenger transportation. That was actually down by 11,000 jobs. That's going to be related in part due to trucking specifically, which echoes some of the concerns that we've heard from those individual workers about how AI is leading to fewer individual routes for truckers and therefore allowing for fewer individual truckers in the field. I do want to mention, though, overall gains in the sector year to date. Transportation and warehousing has added over 119,000 jobs since that low that we saw back in January of this year. And guys, I just took a look to bring it home to here in New York City. We have nearly 300 jobs available right now just in transportation, so that upward trend is likely to continue.
All right, Maddie. Thanks so much for breaking that down. Certainly do appreciate it. Brooke, Madison Mills, and Inez Ferre, thank you. Tracking some of those sectors here. Treasury yields, we're also keeping tabs on that this morning, falling after the July jobs report came in weaker than expected, bolstering the case for the Fed to cut rates sooner rather than later. So how should you position yourself as we approach the Fed's easing cycle? Joining us in studio to help answer that question, we've got Kelsey Barrow, who is the Portfolio Manager for Global Fixed Income, Currency, and Commodities over at JP Morgan Asset Management. Thanks so much for taking the time here this morning.
Absolutely. There's a lot to talk about.
There is. All right, so let's dive into this because we ran through some of the hot parts of this jobs report. You're actually zeroed in on one of the weaker spots that kind of jumped out to you. What was that?
Yeah, so one of the things that I noticed in the internals of the jobs report when you're looking at the sectors is some of the weakness in the higher income categories. So the job losses in the tech sector, in professional business services, the weakness in information businesses, all of those types of things. Essentially, we've known for a while that the strength in the payrolls report was coming mostly from two sectors: education, healthcare, and government and state and local. So I've been more focused on more of the private sector to see if we're starting to see a more material slowdown. Now, the intro, you mentioned the Fed. It feels like the Fed was a year ago at this point, but I think the moral of the story is it's really not about the Fed or the central banks, it's about the data. And the Fed did tell us that they are data dependent, not data point dependent. So as much as I think this report is extremely important, it does solidify the September rate cut, which was our base case. We do also need to be aware that this is just one data point. The 3-month and the 6-month moving average on job gains are still above 150,000, right? We are still gonna need more information. The market, on the other hand, they're gonna run with this. We've seen a very dramatic move in yields. Our positioning ahead of this number, because we were anticipating the start of the easing cycle was to be long duration, was to be in these curve steepener trades. A data point like this is going to accelerate that move.
Yeah, Kelsey, I'm curious what you make of this dramatic move that we're seeing on the heels of this print. You have this plunge lower almost across the board. When you take a look at the 10-year treasuries down 15 basis points, we're right around 3.8. We see a huge drop in the 2-year yield. You also have the dollar moving lower on this. To some degree, does this dramatic move, does it make sense? Is it a bit overdone? Because I think that was also the question going into this print, just given some of the rally that we have seen in treasuries over the last several trading days.
Right. So we were already fully priced for a rate cut in September before the payrolls report. We were already also priced for probably another 1 or 1.5 rate cuts on top of that by the end of the year. So it's not like the market wasn't expecting an easing cycle before this, but now what the market is really questioning is that easing cycle need to be faster? So in a soft landing environment, you're thinking about a rate easing cycle that's 25 basis points a quarter. That's kind of like the pace that people were getting comfortable with. If the labor market is actually weakening more materially, and that's really the circuit breaker. Powell said that in his press conference. Then we could be looking at a pace that's more like once a meeting. They have 8 meetings a year. So that is a substantially faster pace of rate cuts. Now, we tend to overreact on the day of the print. So I wouldn't necessarily be chasing anything here, but this is most definitely a notable development for the Fed. And it does solidify that policy has been restrictive. It's been dragging on the economy slowly. It took a little bit of time for us to see it and appreciate it. It's been a year since the Fed moved the Fed funds rate in either direction. It's about time that we probably need to be looking at that adjustment.
And so with that in mind, I mean, we're watching a move like we are today because even if we had gotten this perhaps 3 months ago, this type of reading where it was a miss on all of the major categories, especially kind of on the headline number, unemployment rate, and then additionally on wages as well, markets would have shot higher because it would have said, hey, this means the Fed has to cut earlier, right? Well, now we're in a position where the markets are concerned with the Fed being too late to cut, and we're seeing a reaction like this where bad news is finally becoming bad news. So what is the playbook now for investors who are trying to best position themselves and not fight the Fed, but anticipate what they're going to do and how that rate policy will play out?
Right. So I understand the reaction in risk markets, and it may be a little bit overdue because they have been not very sensitive to negative economic data thus far. And so there does need to be a recalibration that, yes, maybe the growth going forward is not going to be the growth we saw over the last year, and that's going to be something that people are going to need to adapt to. But one thing that does make me a bit more comfortable about the economic environment and the environment for risk assets is that the Fed has quite a lot of policy space. So if you think about what the Fed was dealing with when they went into the pandemic, they could only cut rates 200 basis points and then they hit zero, and there was nothing really else they could do. You know, we're at 5% right now. So they actually have a lot of room to adjust to keep this cycle going. So I'm not sure exactly where we are in terms of how deep this labor market deterioration will be. But what does give me comfort is the fact that the Fed is willing, able to deliver that easing to help the economy, you know, if we are turning that way.
All right, Kelsey Barrow, JP Morgan Asset Management Portfolio Manager of Global Fixed Income. Kelsey, thank you so much for joining us here on set.
Absolutely.
Let's take a look at the broader market here. Again, we're seeing this move lower in futures on the heels of this weaker than expected jobs print that we got out this morning. When you take a look at the numbers, how many jobs were added to the U.S. economy last month, significantly lower than what the street had been expecting, 114,000. You also have the unemployment rate ticking higher, to 4.3%. In just a few moments, we will be speaking with acting U.S. Labor Secretary Julie Su to get her take on this report. We'll be right back.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief.
Stock futures falling on the back of a much weaker than expected jobs print this morning. 114,000 jobs were added in the month of July. That was far below what economists had been expecting. So let's get right to it. The three things that you need to know to start your trading day. Yahoo Finance's Josh Schaefer, Madison Mills, and Ines Ferre have more.
Investors are digesting a weaker than expected jobs report. The U.S. economy adding 114,000 jobs in July, according to the Bureau of Labor Statistics. That is less than the 175,000 economists had expected. The unemployment rate jumping to 4.3%, up from 4.1% in June, now reaching its highest level in nearly 3 years. The data is a further sign the labor market is cooling, and Wall Street is likely to see this as a sign the Fed should start cutting rates sooner rather than later.
And shares of Apple are on the move this morning here after the stock initially was higher after beating Wall Street's expectations on Thursday. You can see that stock down now just over 1%. That could be part of the broader sell-off that we are seeing in the extended trade, given those jobs numbers. Having said that, focusing here on Apple, net sales rose 5% for the quarter thanks to strong results for the company's iPad and services revenue. Apple's most important business, the iPhone, did beat expectations for the quarter, but saw a 1% decline compared to the year prior. Shares of Apple are still up more than double digits for the year, despite a difficult start, thanks in part due to expectations of an upgrade cycle driven by the Apple Intelligence Service.
And we're seeing weakness in tech playing out this morning. Amazon stock is falling after missing the mark on revenue in the second quarter and issuing softer guidance for the current period. However, a bright spot of the report came from its cloud business, Amazon Web Services, which is a key barometer for the company's AI success. That segment saw a 19% jump in revenue compared to last year. And shares of Intel are plunging after missing Wall Street's expectations. The chip maker announcing a $10 billion cost-cutting plan that would cut 15% of its workforce as part of the company's massive turnaround effort.
Our top story today, stock futures are selling off here after a weaker than expected July jobs report. We did see a leg lower following that print here. The unemployment rate rising to its highest level in nearly 3 years, coming in at 4.3% and triggering the so-called Sahm rule, which signals the start of a recession with the 3-month moving average of the unemployment rate rising by half a percentage point from the previous year. Here to discuss today's print, we want to bring in Josh Schaefer. And Josh, when you take a look at this number here, one of the concerns, risks heading into this print was that it was going to be much weaker than expected. Of course, that then begs the question, what that means for the Fed, whether or not they were behind the 8 ball. But what's your read on this print?
Yeah, I mean, I think the headline is just the unemployment rate, right? The unemployment rate not just ticking up to 4.2%, but ticking up to 4.3%. There was some math that you would have had to do on the Sahm rule. If it was 4.2%, 4.3 kind of gives it a clean break per our math wizard, Jared Blickery, our fellow markets reporter. But I think the broad takeaway from economists instantly seems to be, if you were even considering that September wasn't going to be a cut, the Fed is very, very, very likely to cut in September now. You look at something like the CME Fed Watch tool, which has futures on sort of where people are placing their bets on how much the Fed is going to cut. That's now up to a 70% chance this morning that the Fed cuts by 50 basis points in September. To note, that was 5% a month ago. So the narrative has it feels like it's fully flipped basically since Chair Powell stopped his press conference on Wednesday to now. With the economic data points that we've had in the past couple of days, the 50 basis point conversation was not a big conversation going back a couple of days. Now this print adding to some data that we had out yesterday in terms of manufacturing data and jobless claims data, sort of building that case for maybe the first cut will be a bit deeper than people had expected.
I mean, even if it's not as deep as they might be pricing in or expecting, what does that, though, say, the shift in probability say at least about how much room they have to work with in a cutting cycle that would be initiated?
Yeah, Brad, I mean, I think that the thing to focus on here that we're getting back to is the why, right? Why is the Fed cutting? And that's something that strategists have been telling us on this airwaves for really 6 months now, right, is to keep remembering, yes, you do want rate cuts eventually, but the key is why. And the why has sort of started to shift here because they might be cutting because they're more worried about what's happening in the labor market than actually the trend in inflation. And that's going to be sort of the key thing to focus on. And I think also worth noting as we talk about this July jobs report, we're talking about the September Fed meeting. We do get another jobs print before that, right? And we do know that sometimes this data can shift month to month and not necessarily tell the exact same story. And I think once we zoom out a little bit, that's going to become part of the conversation too, is the BLS said here that Hurricane Beryl didn't necessarily overly impact their survey. They're going to release data later this month to give us a better look at how it did. But some economists are speculating it might have impacted it a little bit. You also had a tick up in the labor force participation rate, which normally when that happens and the unemployment rate goes up a little bit, economists sort of reason more people came into the workforce, the unemployment rate going up isn't totally bad. So there is nuance here with the print. But I think just after yesterday's market action and people being worried about bad economic data, you've got a lot more bad economic data this morning to look at. So I think overall, it's not shocking to see the market action that we're seeing.
And Beryl was just the B name in the hurricane season, which runs through November. So
there's more to come, Brad.
Yeah, we'll see if they have to put more updates like this in their report and the employment situation. Josh, thanks for breaking this down for us. And everyone, stay tuned for our very own Jennifer Schomburger's conversation with Acting Labor Secretary Julie Su, coming up at 9:15 a.m. You do not want to miss that in just a few minutes. Switching gears here, let's talk a little Intel. Intel shares plunging this morning, on track for its largest decline since September of 2000, after the chip maker gave weaker than expected guidance and announced plans to slash 15,000 jobs. Our executive editor, Brian Sozzi, spoke with CEO Pat Gelsinger about the restructuring, and here's what he had to say.
This is the biggest restructuring of Intel, I'd say, since the memory microprocessor decision 4 decades ago. We laid out the new operating model, and we're taking decisive steps to execute on the process and product work that we've done to now combine it with an operating model to make us effective for the long term.
So it's not just that, and of course that is giving us a little bit more insight into how the top brass, the executives, are thinking about this larger runway and ultimately how this is going to take some time for Intel to really get to the type of business that it wants to be. What else are they doing? They're slashing jobs, as we mentioned. They're also suspending their dividend in this near-term period of time. So there was a lot for investors to really have to wrap their minds around what the thesis is for themselves and whether or not they believe Intel could reach that within a 2-year, 3-year, maybe even a 4-year window here.
Yeah, I think the reaction from the street isn't necessarily a surprise given what was in this report. I think there is pressure on CEO Pat Gelsinger. What exactly needs to happen in order to right the ship? They are looking to cut costs. They mentioned the significant headcount reduction. They mentioned the fact that they are suspending their dividend. This, of course, on the heels of the revenue outlook also missing the street's expectations. So he had to do something, right? And I think when you take a look at the probability maybe of some of these negative surprises, and given the street's reaction and given the high bar that was set going into this earnings season, maybe not necessarily a shock when you take a look at some of the selling action going forward. But I think the big question for Intel is what exactly it's going to take to right the ship. This is also not necessarily a new question that investors are asking themselves. This very much has been some of the conversations surrounding Intel, surrounding their CEO, Pat Gelsinger, over the last several quarters. Obviously, on the heels of this print, the pressure really starts to ramp up, and you are hearing some calls just for exactly maybe what ultimately needs to happen at Intel and how long potentially this is going to take in order to convince customers out there that their chips, that their products are worth betting on.
They're trying to turn a yacht into a Carnival cruise line, essentially, and while they're at sea right now, and that's what's happening.
That's complicated.
Look, I mean, yeah, extremely complicated. We're talking about a company that's trying to build out more foundry, more fabrication for itself, so it doesn't have to rely on the services of others to do that, and that's going to be its. Essentially, the analogous term here that I was using, it's cruise line for itself in the future here. So you can chew on that way, whichever one you want at home, folks. But anyway, another tech name that's in focus, Apple shares ticking lower after net sales rose 5% for the quarter, thanks to strong results from the company's iPad and services revenue. Apple's most important business here, the iPhone, beat expectations for the quarter, but saw a 1% decline from the year prior. Here to break down the results, we've got Michael Ng, who is the Goldman Sachs Senior Equity Research Analyst. Michael, great to have you here in studio with us this morning.
Thanks so much for having me.
Let's dive into these results. What was your read here? Any surprises that jumped out at you, especially considering what the broader consumer environment is like right now?
Apple ultimately had a very good quarter. When we look at Apple's results, it beat consensus expectations across all of the key KPIs. That's revenue, gross profit, operating expenses, EPS, free cash flow, and buybacks. iPhone revenue was down 1% on a reported basis, but it was actually up 2% on a constant currency basis. Services revenue grew 14%, showed continued momentum, and the guidance was a little bit better than expected for the September quarter, up 5% year over year. They guided to services revenue to about 13%. That implies about 2% products revenue growth and implies continued iPhone strength. Ultimately, we think this keeps the bull thesis alive and well, which is really about an earnings acceleration and a step up in normalized earnings power, really supported by the upgrade cycle for the iPhone.
Michael, how big of a game changer do you think these AI features are going to be when you talk about the strong guidance, what we are expecting here for this next iPhone cycle? I guess more specifically, what do you think that could potentially look like here for Apple?
Yeah, I'm really excited about the AI features that are going to get rolled out for the iPhone over the next couple of years. In the fall of this year, Apple's going to start rolling out Apple Intelligence for its iPhones, and they're going to expand to more regions and more languages over the course of the subsequent year. One thing that I think is underappreciated a little bit is that in addition to the AI features that are going to help drive consumer demand, there are also going to be fairly substantial form factor changes over the next few years. So for instance, this year we're expecting the iPhone 16 Pro and Pro Max to have a larger screen size. Next year, there are some press reports about a thinner iPhone for the iPhone 17. And the year after that, we're hearing rumors about the potential for a foldable.
No, we don't want that, Michael. Come on.
If you want bigger or thinner or foldable, Apple's there for you.
Really? Okay. I mean, it seems like Apple is always in this kind of, not necessarily full on wait and see, but it's strategy that we've seen from Tim Cook, right? Wait to see what the market is demanding and see exactly how much of that market share you could capture, especially given the install base that you already have. Does Apple need to be first in any of these major investments that they're making right now?
I think when you look at what's happening with AI, it's really illustrative of what you're just asking about. I think for the first half of the year, Apple was viewed as this laggard to AI, right? And after WWDC, I think the markets really changed their perception of how Apple fits into the AI landscape. And to no surprise, people are beginning to adopt the view that Apple's in a really good position to bring AI features to the masses. I mean, it makes perfect sense that the largest consumer hardware company in the world is going to be the one who brings AI features to most consumers. Apple's tagline during WWDC, where they announced Apple Intelligence, was AI for the rest of us. And I think that's what's happening here.
We were so willy-nilly to talk about Nvidia being a $4 trillion, $6 trillion, $10 trillion company at some point. I mean, Apple's the one right now that's sitting at about a $3.3 trillion market cap and is now kind of taken back or at least gotten more competitive against the likes of Nvidia. When are we going to be talking about Apple getting to a $4 trillion or $5 trillion type of market cap here? And what would need to happen?
Yeah. I think what we need to see is a step up in earnings power. And, I think there's been a perception in the market that iPhone units are cyclical, mid-cycle units were probably closer to 225 million. Our view is that it's going to steadily step up. 250 million plus is the new mid-cycle outlook for iPhone shipments each year. And that's really going to be catalyzed by the AI features and some of the form factor changes that will bring up that earnings power. And you're going to have services attached and services momentum to drive those earnings higher.
Michael, real quick, there's a lot to like in this report, but China obviously still remaining weak here for Apple. How big of a risk, how big of a challenge do you see that being in the immediate term?
Yeah, I mean, China was admittedly a little weaker than expected. Revenue was down about 6.5%. On a constant currency basis, it was down closer to 3%. What I would highlight, though, is that the trend is getting better, right? So if you look at the March quarter, China revenue was down 8% year over year. If you look at the December quarter, China revenue was down 12% year over year. So things are definitely getting better in China. And to be clear, China is always going to be a little bit of a concern. It's the most competitive market that Apple operates in, but we think that the trend is improving.
All right. I'm still on the 12 Pro Max, so no generative AI stuff for me just yet here. We'll see if that can get me into a new iPhone. Michael Ng, who is the Goldman Sachs Senior Equity Research Analyst, joining us here in studio. Thanks so much, Michael.
Thank you for having me.
Absolutely. Everyone, switching back to that July employment situation, the weaker than expected jobs report furthering signs of a slowdown in the labor market. Yahoo Finance's Jennifer Schonberger standing by with a very special guest, Acting Labor Secretary Julie Su. Jennifer, take it away.
Thanks so much, Brad. Secretary Su, thank you so much for joining me. It's always great to see you here on Jobs Day. Much weaker than expected jobs report this morning. Does this forebode for a sharper downturn in the job market in store to come?
Well, we're going to keep an eye on it, but I don't think so. And the part of the reason for that is that, again, we look at not just 1 month, but trends, and the 3-month average of jobs created is still 170,000. That is continued strong economic growth and jobs growth. And other indicators are also strong. They do not indicate a recession. They are, we have very high GDP. We have low levels of layoffs overall. Labor force participation rate remains high. We set a new record when it comes to prime age workers, both men and women combined. And so, this is a cooler than expected number. It's taking people longer to find jobs, but they're remaining in the market and looking for them. them. And we continue to have investments that are going to keep on going out into communities to fix roads and bridges and expand access to internet and build fabs that will allow us to manufacture things here at home again. And so those are all some of the, the things we look forward to that will affect the numbers as we go forward.
The unemployment rate bumping up to 4.3% and triggering what is called the Sahm rule, a labor market indicator, which has historically accurately predicted recessions. What is this jobs report telling you about the economy right now?
I think so much about what has happened since President Biden came into office and since the recovery from the pandemic has defied expectations, right? And so, the Sahm rule itself really has not been applied in a situation where you had such a low level of unemployment, especially for such a long stretch as we've had. I've come here many times to say we had this, lowest levels of unemployment for the longest stretch since Neil Armstrong stepped on the moon, right? There's just been a lot of indicators of a low levels of unemployment for a long time. So yes, this was an increase this month. There was also high levels of labor force participation rate still. And so I think there's still a question, the jury's out as to whether the Sahm rule and what it has indicated historically would apply in this situation.
If the job market were to slow further, like you said, this is 1 month, what actions would the Biden administration take?
Well, look, we, again, don't make too much out of any 1 month, but we are committed and remain committed to creating jobs, and not just numbers of jobs, but good jobs. And that's why, we've seen real wages grow. And that's true again, even in this month's report. Real wages, meaning wages are higher than the rate of inflation, more money in working families' pockets. I travel the country and meet with workers who have a union contract for the first time, who are experiencing double-digit wage increases, who have a real voice on the job. The quality of the jobs that matter to us have mattered from day one for this president and our vice president. And so we'll continue the work that we've been doing. We'll continue to make investments that create good jobs. We'll continue to support, workers getting their fair share. We'll continue to combat the massive gap between CEO pay and frontline worker pay, where a CEO makes in a year more than a worker can make in their entire lifetime. These are long-time trends in the economy that we've been working to reverse. They don't reverse overnight, but we've made significant progress, and that's the work that we will continue to do.
On wage growth, we saw that clock in at 3.6%, down from 3.9% the prior month. What's that telling you about inflation?
Well, the work against inflation remains, right? The president has said he's laser focused on it because of actions that he's taken, because of calls he's made to corporations. I mean, again, we see corporate CEOs increase their salaries at record levels. And so this is not, inflation is not an inevitable factor, right? This is something that there's choices that are being made, and we believe that a more equitable economy is not only better for working people, it's a stronger economy, right? Having more equity encourages more growth. So we'll keep fighting for that equity, but we have made real progress in that, and the wages that working people are feeling, the new union contracts. I was just in Fort Valley, Georgia, celebrating with workers who work at Bluebird, their new union contract, and the employer is also saying this is a good thing for us. So we believe that a vision in which employers and employees win through strong collective bargaining is the vision of the economy that we want.
Really quick, the labor force participation rate ticked up very slightly. I'm wondering how much of the cooling in the job market that we saw, the rises in unemployment in certain areas, are attributed to more people trying to join the workforce and look for work versus lower employment.
Right. So labor force participation is another indicator of economic strength. And this last month, we had the highest labor force participation rate in decades for both men and women of prime age. So this is, again, the fact that there are workers who are staying in, right? They're not leaving. They're taking longer to find jobs, but they're staying in the labor market is certainly related to the unemployment rate that we see.
Secretary Sue, we'll have to leave the conversation there. Still so many questions to be had, though. So appreciate your time.
Thank you so much. Thank you.
Shauna, I'll send it back to you in New York.
All right, Jennifer, great stuff. Thanks so much for bringing us that interview. And of course, our thanks to Acting Labor Secretary Julie Su as well. Well, Amazon shares are sliding today in pre-market. You've got shares off nearly 9%. The e-commerce giant forecasting weaker than expected revenue growth, cautious consumers trading down and spending less. To discuss what's next for Amazon, we want to bring in Shweta Kajuria, Wolfe Research Global Internet Managing Director. Shweta, it's great to have you here. So I think the real reason why we're seeing so much pressure here on Amazon is the spending plans and exactly what that looks like here for Amazon going forward. And this is very much being viewed maybe initially as a negative from Wall Street. I'm curious how you're looking at those spending plans and I guess ultimately how you think that should be read by the street at this point.
Sure. First of all, thanks for having me. We view it as a cautious read that it is clear that Amazon is seeing pressure from consumer on higher ticket items. They called it out. However, they've also been calling it out for several quarters in a row that consumers have been trading down and have been looking at lower ticket items. Our view, however, is twofold. One is that Amazon, as long as Amazon continues to gain share, even when the growth is slowing, that's still a positive because they don't control macro, but they can control their share gains. That's point one. And second is that they're enhancing their position to gain share by delivering items faster. And what that flywheel is doing for them is that more folks are buying lower ticket items, like they called out everyday essentials and non-discretionary items on their platform, which is driving purchase frequency and allowing them to gain greater share. So even in a down market, as long as they're gaining share and they're offering consumers opportunities to drive purchase frequency, if it's just macro, I think investors will give them a pass.
Shweta, I'll be the person that says it. AI for Amazon here. They talk about it within their AWS segment, and they ultimately kind of look at this across both generative AI and non-generative AI workloads here. Is the company meeting the mark in terms of what investors would be expecting for some of the investments that Amazon has made, the CapEx that a lot of the big tech companies have earmarked in order to make sure that they don't miss out on the wave of generative AI?
Well, it is a little too early to say. What they have clearly said is that they have seen a very strong uptick in demand for AI features from their enterprise customers. That is increasingly clear. They're also seeing an uptick in the demand for moving on-premise to off-premise, which is just the demand for cloud and the secular tailwinds behind them. What it seems that they are doing, and it's not just Amazon, to your point, it's including Meta and Google, is they're building ahead of any potential demand that they get, because they want to be ready and have that capacity ahead of demand to be competitive. And I think that without Andy Jassy actually saying this, my guess is that he would agree with Sundar Pichai, who said on the public call that they are okay with over-investing because they'll find use case for the capacity that they're building, but they think that under-investing and missing out on this opportunity could have greater negative implications for the business. And I think that most large cap, mega cap tech CEOs would probably agree with that.
Shweta, what do you think this tells us about the likely price action? Clearly, there has been a lot of optimism when you take a look at the year-to-date price gains in Amazon ahead of this report. When you take a look at the last year heading into this print, the pullback that we're seeing today, is that a bit overdone? And I guess, what are you expecting to see looking out here over the next 12 months?
Well, first of all, the pullback partly is also an expectations correction. Mm-hmm. Investors had pretty high bar in terms of the magnitude of the operating income beat that we may see in the second quarter, in addition to accelerating growth in AWS. This retail softness call out was unexpected negative, but we don't want to miss out on the fact that they did produce pretty good operating income beat, just not to the mark that expectations were with investors. So it's partly an expectations correction and partly caution on retail spend. Over the next 12 months, we are buyers here on the weakness because Amazon is a very good margin expansion retail leader, but also an AWS leader story with a very strong advertising growth rate that grew in the high teens growth rate with a video as a catalyst. And so over the next 12 months, valuation here, when we look at it against a Walmart or a Costco even, is not demanding at all. They continue to do really well, and we do see long runway for growth on operating margins for both AWS as well as retail. So we'll be buyers here on the weakness.
Shweta Kajuria, great to have you. Thanks so much for hopping on here with us this morning. Wolfe Research Global Internet Managing Director. Thanks so much, Shweta.
Thanks for having me.
Coming up, we're looking at a sea of red here across the board when you take a look at the major averages, well off the lows of the morning in the future market action here. We've got the opening bell for you when we come back. We've got just about 30 seconds till the opening bell. Let's put up our futures board if we can. Take a look at some of the declines that we are seeing across the board ahead of the open. You've got Dow futures on track to open the day off just over 300 points. This move to the downside coming on the heels of that much weaker than expected jobs print that we got out here this morning. We initially saw a much bigger move here to the downside, so we are off just off the lows of the morning as we ring the opening bell on Wall Street to wrap up what has been a very volatile trading week here for the markets. You're seeing some excitement still despite the downward move in the markets playing out in Midtown at the Nasdaq and also down on the floor of the New York Stock Exchange. But Brad, I think the big question here is whether or not that move that we initially saw on the heels of this print, whether or not we are going to see that intensified selling here throughout the trading day. And then, of course, what this does to some of the calculus out there just about the risk of a recession going forward.
Yeah, indeed. I got to imagine that that's really on the minds of the battery dance folks who were ringing the opening bell at the Nasdaq. And then, of course, you had Seaport Entertainment ringing the opening bell at the NYSE. Let's take a look at the Dow Jones Industrial Average as we kick off today's trading activity, down by about 0.9%. That's exactly where we were pointing to coming into the start of today's trade. Take a look at the Nasdaq Composite, and maybe we can put on a chart view here for the Nasdaq Composite as well, just to give folks a sense of how we fared over this
What do you want, 5
week.
day?
Yeah, let's do 5 day because it's been such a volatile week here. And this right here is that volatility that you're looking for. You got even more of that move lower here on the day out of the gate. Of course, these are technical drawings that you're seeing there. And then we've got to take a look at the S&P 500. That too seeing some declines. At least we did a moment ago see some declines here. Maybe a heat map will fare us a little bit better here on the day. May the odds be in our favor. There we're taking a look at the 11 S&P 500 sectors. XLY pulling up the caboose as of right now. Wow, that's down by about 3.4% for some consumer discretionary names here. Things are oscillating quickly, so I'll click on utilities very briefly here. That's up by about 1.5%, one of the bright spots. Let's get on over to Yahoo Finance's Jared Blickery for more of a look at what's moving, as maybe he'll have more luck with the interactive.
All right, game of whack-a-mole here sometimes. Let's start out with the NASDAQ. You guys were charting the price action for the week, and it has been negative. In fact, we're seeing negativity across all four of the indices. And let's see if we can get to a 4-day, 5-day chart. Well, it looks like the interactive gods not necessarily cooperating, but there you go, down 3%. Worst week potentially of the year, if my calculations are right. So you got to look at the small caps as well. Those kind of fell off, and it hasn't been good when you look at the VIX. The VIX is at the highest level since last October. Then you take a look at the 10-year Treasury note. That is sunk by, over the last 2 days, 10 basis points or more each. That is just an incredible move to the downside. And so while rate cuts are arguably a good thing for risk markets, they're not a good thing if the Fed is perceived to be behind the 8 ball. And so that might be what we're dealing with here. Not that we're seeing that right now, but that is a possibility. All right, just kind of closing things up here, just looking at the 5-day total for sector action. Utilities and real estate in the lead. So it was indeed a defensive week, guys.
All right, Jared, thanks so much for breaking down some of that action that we're seeing here in the first minutes of the trading day. We got much more of your market action ahead. Stay tuned. You're watching Morning Brief. All three major averages opening today's trading day well below the flat line. You've got the Dow off now just around 500 points, so adding to some of those losses that we initially saw here at the open. The Nasdaq, the worst performer of the three major averages, you're looking at losses there of nearly 2.5%. Jobs growth slowing much more than expected for the month of July. And this is just the latest data print, adding to the slew of soft economic data that we have gotten in recent weeks. So here to discuss what this ultimately means for your investments performance in your portfolio. We want to bring in Michelle Schneider, MarketGauge.com's chief strategist. Michelle, it's great to have you here. So let's talk about how exactly the market is interpreting this, because we certainly have seen a shift this week just in terms of sentiment and where investors stand when it comes to that negative econ data prints. So what do you think this move, this leg, this pretty significant leg lower here tells us about how investors are looking at these concerning economic data prints that we are starting to get now a bit more frequently?
Well, first thing, it's a little bit surprising that it took people so long to figure out that this was going to happen, because it was a matter of not if, but when. And you started to see sort of cracks under the surface in terms of certain economic data. And we did see labor starting to weaken a little bit long before we got the print today. So this is probably the typical herd mentality overreaction to the reality that perhaps when the Fed is finally going to start to lower, which obviously is looking out in September, if not sooner, if there's some major crisis, is too late. And so now the question is, what happens from here? Are we going to go into some major bad recession? Obviously, we're starting to see metals do well again, and the long bonds could be somewhat inflationary. So here's that stagflation that we've kind of been talking about, which is really, I think, the bottom line right now. And regardless of what the Fed does, although I don't think they're going to stay high for longer at this point.
You know, with that in mind, I mean, we're looking at, and this is based on some FactSet data here, Michelle, the blended earnings growth rate for the S&P 500 being 9.8%. So despite what's going on in the economy, companies still being able to show that they can exhibit earnings growth. Do you think that remains intact? And if so, for how long can they deliver that to the street, especially if we do see a Fed that's going to have to react to a worsening economic reading, at least from their gauges?
Well, I think maybe the needle has swung too far the other way right now, because, yeah, you mentioned some good solid earnings. And I think we have to look at the consumer here as, of course, 70% of the GDP, which was good last month. And really, it's a matter of what are the consumers going to do at this point, and what are they going to consume? We obviously can see that staples have done better than discretionary, and that might continue for a while. But I think with these earnings companies, it's going to be a matter of, does inflation pick up again? That's the key. A lot of these companies were able to maintain good earnings because inflation has come down, even though we've seen pockets here of prices going up depending on what area you're looking at. And that's going to be what's going forward. So if we're going into a stagflationary environment, there'll be companies that'll be able to get through it. Obviously, the big companies, we could see Apple, for example, was up already today. And then there'll be other companies that will, we saw also a lot of negative earnings, and I think we'll start to see some of these companies that have not such great balance sheets not do so well, and others that have had terrible balance sheets maybe do better in a lower interest rate environment, again, if inflation doesn't really start to pick up.
When you take a look at the technicals, as you very much do, closely watching that, what kind of adjustments or moves should investors be keeping in mind, given what we could see in terms of the outperformance of some of those larger cap companies that are able to withstand what will be a volatile environment versus others who may be more subject to some of that risk?
Well, I can only tell you what we've been sort of preparing for. And in some ways, I'm actually quite pleased to see this type of sell-off, because there were pockets that I really were interested in that were getting a little too extended. So if we start with the big caps, for example, obviously Amazon went down, and I think that at some point you might be able to see a good buy here. I don't like buying a falling knife, but once we start to see some settling, I would certainly look at Amazon. I would look at Apple. But I want to move over actually to Tesla and EVs, because one of the things that I am pleased about here is that I didn't want to get into Tesla at 260 if you missed the initial move up. But at 205, 210, 215 in this sort of $10 area, probably not so bad. Rivian was another one, maybe the number two. Of course, the difference in the stock prices are enormous, but at $14 a share, it looks so much more attractive right now. It's got earnings coming up, so that's something to be aware of. And I think even in the consumer area, we had something like AbbVie go crazy, which is all a reflection on this diet drugs. And I think we'll start to see some good opportunities in what I'm calling the vanity trade. And then, of course, Bitcoin, we have to talk about that too. This could be another great buy opportunity as it's come off. And I'm looking at blockchain. So I think you have to just pick your areas carefully, assuming now that the economy has shifted to buy everything. And instead, let's look at what could survive a stagflation, possible recession, or maybe even a bigger inflation, which of course would be geopolitically involved, I think, at this point.
Calculated diversification is the word, or two words. Michelle Schneider, who is the MarketGauge.com chief strategist. Michelle, thanks very much for taking the time here.
Thank you so much.
You got it. All your markets action ahead. Stay tuned. You're watching The Morning Brief.
We're watching two energy giants today. First up, ExxonMobil posting a 17% rise in net income from a year ago after seeing record production in Guyana and Permian Basin. You're looking at gains just shy of 1%. On the flip side, though, Chevron, on the other hand, missing second quarter profit expectations. You're looking at losses there shortly after the open of just about 2.5%. Ines Ray joining us now with a breakdown of the two. Hi, Ines.
Hi, Shauna. Yeah, and as you just mentioned, the key takeaway really is that Chevron missed on earnings expectations on lower refining margins, while ExxonMobil beat expectations. Both of these companies' performance really driven by their oil and gas production. So let's take it case by case. In the case of ExxonMobil, the Pioneer merger, which closed relatively quickly, contributed to about $500 million to earnings in the first 2 months post-closing with record production. So Pioneer, by the way, is expected to add even more to Exxon's production next quarter. And one interesting note, ExxonMobil sees 2050 oil demand in 2050 up by 15% from today. As for Chevron, the company announced 3 Chevron senior VPs retiring. Chevron also moving its headquarters from San Ramon, California to Houston, Texas. So another company that goes to Texas. And as for the stake in Guyana and that asset that is in dispute and holding up that Hess merger, both of the oil giants, ExxonMobil and Chevron, are confident that each one will win. Darren Woods of ExxonMobil's CEO saying that the arbitration over Guyana will be resolved in September 2025. So that is quite a bit away for Chevron to wait for that, guys.
All right, and as for Ray, thanks so much. Continuing to keep tabs on the oil and gas space here and energy more broadly. Appreciate it. Let's also keep tabs on Snap shares, the brand of Ghostface Chilla, plunging after its third quarter guidance came in below expectations. Monthly active users did rise from 800 million to 850 million in the quarter. But there you're taking a look at shares right now down by about 21%. And the shareholder value really has been a ghostly disappearing act since about mid or early July here as we've been continuing to track Snap shares. One of the things that they did call out on this earnings call was that there was particularly weak demand from certain consumer discretionary verticals, including retail, technology, and entertainment, as well as the timing and impact of holidays shifting out of Q2 in the current year. Some of that similar a little bit to what we heard from Pinterest with regard to some of the verticals that are underperforming versus those that typically were the staples that would outperform, but where they're seeing some weakness here. So that also hitting Snapchat as well here. But they are saying that they did continue to make progress. They mentioned on the earnings call towards diversifying their revenue sources. That is something that investors are going to want to hear more about. The revenue is up by about 151% year over year in Q2 at least.
Yeah, I think Snap, I mean, when you take a look at this company, it's very much the same narrative that we've been talking about over the past couple of quarters, kind of struggling for direction, how exactly they fit in a landscape of a growing competition landscape, ones where competitors continuing to gain market share, at least when you take a look at the overall basis here of Snap. And I think when you look ahead, the fact that they're not significantly growing their user base, they're kind of lost in the mix here of the social media platforms. I think a lot of analysts here at this point, at least, are struggling to see ultimately what that catalyst is going to be for Snap moving forward. Yes, they have placed some bets that haven't exactly worked out in the past. And I think given that under the same leadership here, I think many are now starting to question about how long, what that timeline looks like in order to regain momentum. But I think even beyond that, beyond the timeline, it's more what is it going to be that's really going to change the investment thesis surrounding Snap and the fundamentals. And I think when you take a look at some of the trends that we've seen in the last several quarters here, at this point, we haven't seen a significant change. And this is a stock that very much does tend to see wide swings, really in either direction on the heels of its print. So again, the fact that we are seeing such a large move, a significant move here to the downside, not necessarily surprising, given the fact that it did disappoint the street's expectations.
You know, it really comes back to just the time spent on the platform. And they faced a few of those questions on the earnings call as well. One particular analyst just asking about the changes that are pressuring the time spent and what's actually happening here. And if you look across the mix of what we've heard from social media companies over the course of this earnings season, Meta leaning further into Reels to make sure that there's more content creator tools, also making sure that they're mixing in more ad load with that. That's a double whammy for a company like Snap, because that means more time spent creating on a different platform, and then advertisers also going to where that time spent is going. And then you look at TikTok and how that continues to perform. But I think also for Snap and Pinterest, what we've heard specifically is they're in this kind of jousting period right now, figuring out what other levers they can pull in terms of their own tools and creativity. Pinterest is doing collages. We'll see what Snap does. AI lenses, I think, is the...
Back to what they've done before.
Oh, yeah, right?
We'll see.
Yeah,
I don't know
technology.
how it works out second time around. All right, let's take a look at Block because that also reported results here. They were out with a mixed report, but you're looking at gains well off the highs of what we saw shortly after this move higher. But I think what the street is focused on and why we are seeing an optimistic view of this print is the fact that Block actually boosted its adjusted EBITDA guidance here for the year. That topped the street's expectations. And when you take a quick look at the street's reaction to this print, JP Morgan, the team there, saying that this top and bottom line beat was solid here from the company. They also went on to say that the focus on the go-to-market strategy should be, quote, music to investors' ears. And Jefferies, the analyst there, Trevor Williams, saying that the results are about as good as could have been hoped for here at this point. He also went on to say that the full year gross profit outlook underscoring some of that durability of growth here across their segments. So again, the street looking at this as a very positive move here in the right direction. We are well off the highs that we saw initially following this report, but again, shares still trading to the upside.
Yeah, just to get some Bitcoin mentions in the SEO on this video as well here once the transcript posts. Bitcoin gross profit was $67 million in the second quarter of 2024 for Block. The total sale amount of Bitcoin sold to customers, which they actually recognize as revenue, Bitcoin revenue specifically, that was $2.61 billion. And Bitcoin's gross profit for them was 3% of Bitcoin revenue here as well. So all the BTC mentions.
All right, Nvidia is reportedly facing another probe from the Department of Justice. We're going to break down all you need to know after the break.
Nvidia shares are in the red today as we're taking a look at the declines here. The U.S. Department of Justice investigating the chip giant for antitrust concerns after its run AI buyouts. Now, according to Politico, Nvidia acquired the AI startup back in April of this year, reportedly spending $700 million on the deal. And, you know, as we're kind of continuing to really parse through all of the rapid M&A that's taken place within, whether that be kind of soft acquisitions or at least making some type of major investment in a company and maybe not acquiring them outright, but having some type of exclusivity that's tied to that investment. I think for Nvidia, for Microsoft, they've been two of the poster children that have been known to throw some of that cash around and make some acquisitions that typically regulators wouldn't really bat an eyelash at. But in this position, I think now regulators are trying to make sure what happens now is not the same or a repeat of a Google or an Alphabet back in the day, a Google back then acquiring DoubleClick that really assured that it was going to have this almost monopolistic type of positioning within the digital ad market here. But this time we're thinking about the generative AI landscape.
Yeah, I think just to put this simply, they're looking into whether or not there are any concerns just about, given NVIDIA's dominance within the space, the concentration here of new technologies, the fact that it is in the hands of few companies. That is why they're looking into this acquisition, just ultimately what that means for competition here going forward. And actually, this is not the only DOJ report that's circulating surrounding NVIDIA here today. There's also a new report out from the Information saying that the Department of Justice officials have reached out to NVIDIA competitors, including AMD, looking into their practices surrounding sales of artificial intelligence AI chips. Now, that report saying that they are looking into whether NVIDIA had pressured cloud providers to buy multiple products. So again, that report is from the Information. The other report that Brad was just mentioning there is from Politico there, surrounding their acquisition of Run AI, which is that Israeli startup company that looks into the virtualization here of GPUs. So again, two reports that are out this morning, one from Politico, one from the Information, detailing potential DOJ probes here into NVIDIA, or looks here into NVIDIA. All of it, though, surrounding really based on their dominance right now within the AI chip space. All right, coming up, a weaker than expected jobs report triggering the Sahm rule recession indicator. We will be speaking with the creator of the Sahm rule, Claudia Sahm, on the other side of the break. That's coming up next on Catalyst. It's just after 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills. And let's dive into the catalyst moving markets today.
The strength of the labor market starting to fade here. Unemployment coming in at 4.3%. Only 114,000 jobs added in the month of July, falling far below the estimate, which was 175,000. That triggered the Sahm rule, a key recession indicator. Acting Labor Secretary Julie Su joined Morning Brief earlier this morning. Here's what she had to say about that.
There's just been a lot of indicators of a low levels of unemployment for a long time. So yes, this was an increase this month. There was also high levels of labor force participation rate still. And so I think there's still a question, the jury's out as to whether the Sahm rule and what it has indicated historically would apply in this situation.
We'll be speaking with Claudia Sahm about exactly that. She is the economist behind that rule in just a few minutes.
And we're seeing the reaction to the jobs report across the broader markets. The tech-heavy Nasdaq taking the brunt of the selling here. Taking a look at those losses, off well over 2%, on track for its worst week of the year. That weaker than expected jobs report, coupled with disappointing earnings, is really driving the Nasdaq into the red here this morning.
Plus, chip stocks continuing their moves to the downside today. Intel leading the sector lower, down over 27%, and what could be its worst day since the early 1980s. Nvidia also moving to the downside today following its rally earlier this week. We'll dive into whether or not there's a buying opportunity in the chip stock.
But first, we want to take a closer look at the market's reaction to that weaker than expected jobs report. We have the Dow falling just over 400 points right now. You've got the Nasdaq off nearly 2.5%. We're seeing this move lower on the heels of that much weaker than expected jobs report. The market's starting to price in bad news for the economy as bad news for the market. So here with a closer look on someone that has been tracking some of this narrative very closely is our very own Josh Schaefer. And Josh, it's the shift that we've been talking about now more and more here, and we're starting to see it, continuing to see it play out in today's early action.
Yeah, Shauna, I was listening to you ask several guests this question yesterday, right? Which was just simply, when is the turning point? When is bad news for the economy going to be bad news for stocks? And you were asking it because that hasn't necessarily been the case over the last year, right? Bad news for the economy could have meant that growth is slower and it is not a problem for inflation. But I think Fed Chair Jay Powell actually gave us pretty clear guidance on this. If you listen closely to what he was saying on Wednesday, he essentially said the labor market, growth in the labor market at this point is not a concern or an inflation pressure that they are worried about. So that gives you a pretty straight read here that you should want the labor market data to not come in weaker. They're not rooting for the labor market data to come in and keep cooling, as we were talking about over the last couple of years, right? You're looking for the labor market to basically stay flat and normalize. And so when you get data like this, it has people concerned about the trajectory for U.S. economic growth. And you're just seeing a clear trade over the last 2 days after that jobless claims data, the manufacturing data. Now we have the jobs report. There is just a clear trade here into defensives. You have some defensive sectors up today, right? Should note that action that you're seeing. And you're seeing just pure sell-offs in some of the rate-sensitive areas. I mean, the Russell 2000 is down over 3%, I think, right now. It might be up to 4%. That had been something when you're pricing in more Fed rate cuts. That had been an index that was ripping through July, right? As we were getting more positive about the rate cuts, the Y has changed. We're talking about a Y that might be a concerned Fed that is playing out in the market.
Well, Josh, you mentioned the market reaction with the Russell 2000, and that's on your screen here. You can see over the past couple months it has turned into positive territory, but as you mentioned today, it's down over 3%. I'm curious what you are reading and hearing from folks about how long the market pressure we're seeing today is going to last. Is this a temporary, perhaps, overreaction?
Well, I think it's an extension of some of the washout you started to see last week, right? Shauna and I actually both wrote about this last week, talking to different group of strategists, right? So we had a broad group of strategists that we talked to in that sense.
Teamwork. We were on the same page.
But they both highlighted to us, right, Shauna, that essentially they thought there needed to be more of a washout in tech.
Yeah.
I spoke with Keith Lerner over at Truist, and he had said he thought maybe tech gets a little bit of a bounce off some of the earnings, which you did see a little bit earlier this week, right? You saw the Nasdaq fight back a little bit. But he said in the long run, he was looking for something closer to probably a correction, which we're hovering near today, a 10% pullback. He thought that we needed to fully wash out because you still had a lot of stocks trading above their 50-day moving average, still in pretty good position, and it wasn't nearly as close to as far as we drew back in April or as far as we drew back last October. Think about the other drawbacks we've had in this bull market. It usually just goes a little bit further. And so right now, a lot of folks are still talking about this being a rotation, It's not a recession panic and everyone's getting out of the market. You have 4 of the 11 sectors up today. People are still looking to put money to work somewhere, but it's still that rotation, and maybe we need a little bit more of that rotation for people to feel like they want to come back into tech.
It's a really good point, Josh, and important to look at because, you know, as I put in our chat earlier, recession is like the top trending word on Twitter right now, or X, whatever. So it's
one jobs report. Remember, it's one jobs report.
But after jobless claims yesterday, so it's 2 pieces of economic data. All right, Josh, thank you so much as always. Great reporting. We appreciate it. Sticking with that jobs report, the unemployment rate jumping to 4.3%. That is the highest level in nearly 3 years. And it triggered a rule created by our next guest. That's called the Sahm rule. It says that if the 3-month moving average of the unemployment rate rises by 0.5 percentage point from the previous year, that signals the start of a recession. Here with more is the creator of that rule, Claudia Sahm herself, the chief economist at New Century Advisors. Claudia, it's great to have you, and thanks for joining us here. As I just described, it is a recession indicator, so help me and our audience out here. On a 1 to 10 scale, 1 being as far as possible from a recession and 10 being absolute recession territory, where would you say we stand today?
If I were to just look at the rule, so this is a pattern that's held historically, and it's been very reliable. So the way you would interpret this rule normally is we are probably about 3 months into a recession. Now, is there anything about the world right now that is normal? No. And so the Sahm rule and many other indicators we've had of, say, recessions, like 2 quarters of GDP declines. We had that in 2022. We had no recession, right? Like, we really have to think about the particular context for now. So do I think we are in a recession right now? No. Do I think that the increases in the unemployment rate and the softening in the labor market is worrisome and we could end up in a recession in, say, 3 months, 6 months? Yes, I am very concerned about that. But the Sahm rule is probably overplaying it right now to some extent, just because of pandemic induced and labor force. We just had a lot of shocks we're working through. So there's kind of some extra now, but we should be very concerned. So this is high up on the 10 scale, not a 10 though.
Claudia, talk to me a little bit more about that last part of that sentence that you just said, just why it is different this time around. Clearly, we saw shocks to the labor market throughout the pandemic, and then even coming out of the pandemic, immigration also playing a massive role in some of that uptick that we have seen most recently.
Right. So the recession indicator, it looks at changes in the unemployment rate, right? Because as a country, we've gone into recessions with really low unemployment rates and really high unemployment rates. So it's looking at changes, looking at this momentum, that once you get enough going, you're in a recession. Okay, so there are things that have happened that have really moved around that change in unemployment. We had the labor shortages earlier on when people dropped out of the labor force because of the pandemic. That pushed the unemployment rate down really low. So we're comparing to something really low. And then in recent years, we've had a big surge in immigration and other people coming in from the sidelines, the labor force. It takes time to find a job if you're coming in from the sidelines. That does push up the unemployment rate. As long as it does that temporarily, right? And then we get people working, that's great. But so like that aspect of these big changes in the labor force that were not only big, they were fast, has just made an indicator like this that's trying to figure out the momentum more challenging than we have seen in any of the historical record that the rule was created off of.
So Claudia, squaring that then with what you answered to Maddie's question, the chances here that we could see a recession in the next 3 to 6 months. I guess what would you place those odds at now? And when we talk about maybe the likelihood here, what would make you even more concerned? Clearly, it would be if the unemployment rate increases, that sort of thing. But is there anything else maybe outside of those metrics that you're closely watching that would be a bit worrisome here for the economy?
Okay, so the odds of a recession are elevated in the next 3, particularly 6 months or so. It's not my base case. The reason that I see a path out of this, that's a good path, is we do have, in particular the Federal Reserve, has some important policy levers that it can still pull in terms of gradually lowering interest rates. We have a really healthy economy. We're just like pointed not in a good direction. So just take a little bit of pressure off, or as much pressure off as they need to, and we can get this back to more of a glide path. Like the problem is not where the U.S. labor market is right now. Close to 4% unemployment is good. We've had a lot of increase in the labor force. We need to stay in this place. If we get month of this weakening, that's the problem. And I think the policymakers, there are some tools to help smooth that out, and they're pointed in the direction of doing that.
Claudia, we're hearing some commentary already this morning about the potential for the Federal Reserve to make a move before that September meeting, and we're also seeing the market pricing in a higher likelihood of a 50 basis point cut come September. What is your base case?
My base case is they're going to get going in September. I think it's pretty clear that it's necessary. The Federal Reserve, outside of their regularly programmed meetings to make changes in the interest rates, we would be in a crisis situation. None of us should want a crisis situation right now. And we are not in a crisis. Like this labor report is really disconcerting. It is not a crisis, right? What we could see is Fed officials coming out, and as they give their guidance or communication, we could have them really talk up, we're willing to do whatever it takes to make sure we don't see more weakness. And I think that could give some support, and yet, they want to be measured. They don't want to go into panic mode. I think that's appropriate. And yet, just even 2 days ago, this is not the labor report that Jay Powell thought he was going to see. They were very clear. They don't want to see more weakening. We saw more weakening.
And Claudia, I want to end by talking about where we are heading come November in terms of the toss-up with the White House. I know that often your rule can get a little bit politicized. I'm curious what you want folks to know today who might be listening to commentary about your rule and how it could play into any sort of political commentary on both sides of the aisle as we head into November.
Yeah, I'm sorry. Like the goal of the rule was to be able to put fiscal policy on autopilot in recessions and avoid some of the politics, right? So I know that's not, that's being naive now, I understand. But it's important, like we don't want to panic. Again, I think there are some good reasons that this time has some unusual features. And really the purpose of the rule was to take action to, if we get in a place that is not a good place in the economy, we take steps to make it not as bad, fight the recession. And in this case, I think we actually have some runway in that we're not in that danger zone yet. So I hope it spurs a conversation and a let's pay attention to the labor market. And this needs to get under control because it's so important, and the labor market's so central to just the health and growth of the economy.
Claudia, real quick, before we let you go, how are you looking at some of the other data that has been coming in, more specifically some of the reading that we are getting on the consumer? There has been lots of questions about the pressure that consumers are under, whether or not we're seeing some of that material weakness play out. What do you think?
Right. And that absolutely, looking at all of the data. So the Sahm rule was designed to be this summary statistic that could roll it all up. Frankly, right now, nothing is a summary statistic of the economy, right? Like it's complicated enough. And so when I say we're not in a recession, it's not just me being, oh, I don't want that to happen. It's look at consumer spending, look at income. No, they are not as strong as they were before in terms of growth, but they're still really solid, and inflation is coming down, and we can cover. So it's like if you look at the whole landscape, we're still in a good place, but the direction of travel is a problem. But we can, that's not a done deal, right? So I think, if you look at everything, it can look pretty good, but it is easy to go out and pick out a set of data points and be very downbeat. And I don't think that's the message that we should be taking from today.
Claudia, final question for you. The decrease in job leavers, and you noted this in your recent Substack post, is now larger than it is in most recessions. If you had to put a percentage on it, and I hate to ask you this again, but what percentage likelihood do you think it is that if we do continue to see weakness coming into the next jobs report, and if we see weakness in the upcoming CPI prints before that next Fed meeting, what percent likelihood do you think we would have of the Fed responding outside of the next policy meeting?
Responses outside of policy meetings are very rare, and they're usually driven by a big disruption in financial markets, right? Like in crisis. So I don't see that happening. There's always a chance, and but in terms of it being driven by some macro development, I just don't think they have other tools to be able to signal. We can move, but again, the message today is not crisis. Message just. There are some issues here. This is not, we need to get this straightened out.
Someone needs to tell the market that, it seems like, Claudia.
Claudia Sahm, it's great to have you, especially on a day like today. We thank you so much for making the time for us. Chief Economist at New Century Advisors. Thanks, Claudia. Let's turn now to a big story here this week. We're taking a closer look at the tech trade. Nvidia is the next big test for the market when you take into account earnings. But as it stands right now, you got to look at the moves that we've seen in Nvidia today and this week. Taking a look at today's moves, you're looking at another day of losses off nearly 7%. As it stands right now, when you take a look at tech overall, the Nasdaq 100 is down more than 5% this month, meaning that August is already tracking for the worst month of the year. And we're only in day 2 of the trading day here for the month of August. So here to discuss what's ahead for tech, we want to bring in Ayoka Yoshioka, Senior Portfolio Manager at Wealth Enhancement Group. It's great to have you, Ayoka, and thanks so much for taking the time to join us here this morning. I'm curious, we can start with Nvidia because that certainly has been a wild, volatile ride here this week. I think the initial read on some of these big tech earnings reports was that the spending that's planned here for AI, that is actually viewed very positively here for names like Nvidia. But since then, we've seen some selling action. So I'm curious what your big takeaway from this week's crazy week that has been is so far.
It's been definitely a much more volatile week than we are used to in markets. But we, started, I think, July with the VIX at 12. And so, perhaps markets were a little bit complacent, going into earnings season here. And so, now that we've had a good look at many of the tech earnings, we did see that spend and most likely going to Nvidia for their GPUs. However, sentiment and the earnings bar was very high going into earnings season. And I think you're seeing a lot of that sort of come out just because expectations were very high. And the reports were okay, but nothing great.
Is any dip that we see in Nvidia still a buying opportunity?
So I think with Nvidia, you have to be patient and, you don't have to go all in right here, right now. When momentum starts to roll both on the upside as well as on the downside, it tends to continue a little bit. So, for investors, we think you should get comfortable with some of the volatility. If you don't like seeing the stock down 6 to 7% on a daily basis, it shouldn't be something that, you should put in your portfolio. However, the long-term aspect, and again, depending upon your time frame, it could be a great opportunity simply because, AI has very long legs, especially as so many companies are investing in what the potential could be with AI.
And taking a look at some of your top holdings here, Microsoft, Amazon, Meta, amongst the names in there, among the tech giants here. I'm curious, coming off of these earnings prints that we've gotten this week, then who do you think is best positioned at this stage, at least for the next couple of quarters?
Funny enough, I think when you look at it from this CapEx lens that everybody's been talking about, Apple is up today. And, Apple only spent $2 billion in CapEx this quarter. And, their CapEx spend continues to stay pretty low, which means that they have a lot more free cash flow at their disposal to return to shareholders. And in this environment in which the economy is moderating and we're a little bit more concerned that the data is getting worse, that's kind of the area that you want to be in because you know that you're going to get that return back as a shareholder. Right now, some of the other companies are growing quite a bit, Microsoft, Amazon, and they will continue to grow, over the next several years. However, in the short term, you may not be getting that return back in terms of free cash flow.
For Apple, there is a lot of hope about an upgrade cycle to come with Apple Intelligence leading to, an upgrade cycle because people want an iPhone that has these AI tools. How confident are you that that's actually going to come to fruition?
It's tough. I think, behavior for most people is difficult, and especially in the economic backdrop that we do have right now, where people are scaling back on spending. And, unless you really have a compelling argument to switch and upgrade your phone, it's tough to shell out another $1,000 or more for a new phone. So I think Apple's really going to have to demonstrate the value proposition of having all of those AI capabilities within their phone.
All right, we're going to have to leave it there. Really appreciate you joining us, Ayako Yoshioka, Senior Portfolio Manager at Wealth Enhancement Group. Thanks so much. Coming up here at DraftKings, also out with their latest earnings print. Their CEO is going to join us right after the break. Let's do a check on shares of DraftKings. Right now, they are down over 11% here. This comes after a mixed earnings print, results showing that the company missed on revenue expectations. DraftKings also teasing out a new surcharge for customers in states with higher taxes. For more on the potential implications here, we want to welcome in DraftKings CEO Jason Robins. Jason, thanks for coming on. I want to start on your outlook because this was a key data point for investors. When you're looking at the balance sheet and what changes you want to make to bolster that outlook moving forward, what would you want to tell investors is the single biggest change that you're going to be able to make moving forward?
Well, I think really it's less about a big change and more just investment in what is an incredibly strong customer acquisition environment. The big change we're going to be making for next year is the implementation of the gaming tax surcharge, which will not affect this year. So, Illinois, which raised taxes, is going to be about a $50 million hit to EBITDA in the back half of the year. But we do think that there's some optimism that the gaming tax surcharge will help offset next year and maybe even deliver a positive EBITDA tailwind.
Jason, I want to talk to you a little bit more about that because the reaction, at least from the street's perspective, was a bit mixed just in terms of how this could be used maybe as an advantage by some of your competitors to gain market share, whether or not this is something that you could see some sort of backlash with when it comes to your users. How do you view that?
Well, let's see what happens. I mean, I think most, I would imagine most in the industry are looking at the same math we are, and over the long term, companies need to make a profit. So I think, there might be others that choose to invest less in product and other sorts of customer experience, and that'll be a decision they're making. And we're confident that, listen, everybody has the same total margin to invest with. So, everybody has to make their decisions about where they put it. And we've always said that we think product is the most important thing, customer experience the most important thing, and we want to make sure that we can continue to invest there, because that's really, forget even our legal competitors, that's the best way we can compete with the illegal market, which is paying no taxes. So really, for us to be able to continue to make those investments, we have to be able to make a profit in states that have high tax rates. And the reality is that it's not just New York now, there's a few of them.
Yeah, and Jason, that certainly makes a heck of a lot of sense from a strategy, from your strategy standpoint. I'm curious, though, if we take a step back, maybe what this more tells us about some of the trends that we are seeing play out within the online sports betting space. When you take into account that many of the states that have legalized gambling most recently have had higher tax rates, is that something that you think is going to be likely here as we talk about a wider adoption and more states legalizing sports gambling?
Well, it's not entirely true. I mean, if you look at most states that have recently legalized, they have not had a higher tax rate than that 20%. North Carolina, Ohio, and Massachusetts, which were, three big ones over the last year, all are at 20%. States like Kentucky were below that. So it really hasn't been. Illinois, unfortunately, raised their tax rate, but they have been, live with a 15% tax rate for quite some time. So, it really is only 4 states right now that have had, Washington, D.C. as well. But, you have to remember there's 25 states plus D.C. that have legal online sports betting now, 38 that have some form of legal sports betting, and only 4 have that, I think, tax rate above 20%. So it's really not most states. And, I think most customers won't be affected by this is the reality.
For those customers who are impacted by it, can you operationalize for me how you plan on including this in the platform moving forward and what that might look like in practice?
Yeah, so we have some shots of product visuals in our investor deck you can look at, but it's very small. In Illinois, it'll be low single-digit percentage charge on the net winnings. So, for example, if you bet $10 to win 20, you might be getting $19.60-something cents instead of 20 back once the charge is deducted. So it'll be very transparent. A lot of people ask me, why didn't you just bury it in pricing or something like that? And the reality is that, while certainly, maybe people notice it more, and I realize that might lead to more complaints, I think the trust and the ability for customers to know that we will always be transparent with them, that is sacred. And so, we're taking a very transparent approach. It'll be clearly line itemed out. There'll be no question about it, but it's a small amount. On that bet I mentioned, 10 to win 20, it amounts to about 30-something cents in Illinois. So hopefully customers will not see it as a huge thing. I think a lot of customers in other industries like hotels and taxis and many other things are used to paying, fees in states that charge taxes. In fact, most of those industries charge 100% of the tax back to the consumer. We're only charging a portion of it here.
Jason, let's look ahead to the NFL season. Critically important as season, a couple of months here coming up for you. What are your expectations just in terms of participation and how much growth you're expecting to see this year versus what you've seen in years past?
Well, I think this is going to be our biggest NFL season by a long shot. Just the momentum we have on the customer acquisition side and general activity side going into it. And this is usually our least busy time of year. I mean, we do have Olympics, a few other things, but for the most part, this is generally the slowest time of year for us just due to the sports calendar. So to be seeing the kind of customer acquisition we're seeing and activity we're seeing now, I think bodes really well for what I think is going to be an absolutely massive NFL season, and then right on into the fall, into NBA, NHL, World Series, and all those other great events. It's this is the best time of year from my standpoint, from a sports calendar perspective.
All right, Jason Robbins, always good to talk to you. Thanks so much for joining us here, CEO of DraftKings.
Thank you for having me.
We appreciate it. Shares of Bank of America are falling along with the broader markets, important to point out, but you're taking a look at losses here for Bank of America of just about 4%. Now, the headline surrounding Bank of America specifically this morning is that Warren Buffett's Berkshire Hathaway have to buy offloading more Bank of America shares. When you take into account exactly what this ultimately means here for the stock, it is under a tremendous amount of pressure. Now, this is something that has been occurring over the last several trading days. And I think at this point, investors are asking what exactly it is that Berkshire maybe sees coming down the pipeline, what it is that Berkshire sees, if there's any sort of shift or change maybe coming along for Bank of America, just what is sparking this consistent selling of shares. It is important to point out, though, they do remain an extremely large shareholder within Bank of America, so their stake remains large. They are still betting very much on the success of Bank of America here going forward, but they have been trimming their stake pretty steadily.
Yeah, it's interesting to point out the kind of broader number here. This is a total of $3.8 billion worth of Bank of America shares from mid-July. That makes it the biggest sale of the stock in its entire history. And one potential driver of this, there are, of course, many potential reasons that impact Warren Buffett's thinking, but one could be the broader economic cycle that we are in right now. We just got that latest jobs report showing potentially signs of continued weakness in the economy. We are seeing in the broader bank space, bank stocks sliding. You can look at the benchmark KBW Bank Index down over 4% today. That's the biggest move that we've seen since May of 2023. So potentially this is Warren Buffett and the team over at Berkshire anticipating some of the economic weakness that we have been getting and the impact that that has had on some of these bank names.
Yeah, and as of Thursday's close, you have Bank of America falling to the number 3 spot on Berkshire's list of top holdings. Now it trails behind Apple and American Express. I was mentioning the fact that they do remain very large shareholder there in the bank. It remains the largest shareholder still in Bank of America with a 12.1% stake.
Yeah, it's a really interesting story to monitor just in terms of the degree of the sell-off there. We're going to stick in the banking space, though, with some CEO news. JP Morgan Chase CEO Jamie Dimon weighing in on the presidential race. He wrote in an op-ed for the Washington Post that the next president needs to unite the nation, but a critical piece of information here, that the next president should consider the private sector's, quote, indispensable role in the world by adding a cabinet seat. Dimon also not endorsing any specific candidate in the article. Joining us now to discuss this, we've got our very own Rick Newman. So Rick, that cabinet position idea from Dimon, really interesting here. I mean, do you think that there is any likelihood of that suggestion being taken seriously by policymakers?
Well, I think that would require an act of Congress. And frankly, I think the Washington Post got the headline wrong on this story. I think the headline should be bromides from a billionaire. I think this is Jamie Dimon's weakest take in memory. It's like the JP Morgan PR department got their weakest writer and said, hey, string together some platitudes. Jamie Dimon needs another byline. I mean, I went through this. First of all, the president must restore our faith in America. I think if you ask Joe Biden would say that's exactly what I did. I ended the chaos of the Trump years. Biden's administration, he's not popular, but his administration has been almost entirely scandal-free. There's been no chaos like we saw during Trump. He wants to do things like reform the Supreme Court to make it more answerable to American public opinion. And then if you go through, Jamie Dimon listed 5 points here. They're all vague, and he's not really saying exactly what he probably means. But I read 2 of them to be, let's make sure Trump doesn't get elected. Like, for example, he says we need to respect America's crucial role in world affairs. Well, that is basically the opposite of what Trump said, Trump the isolationist. But Jamie Dimon won't just come out and say, don't elect Trump. I mean, he says, our leaders need more courage, and yet Jamie Dimon won't say what he probably means. I mean, I could go through the rest of this, but, just one other thing. We need more prosperity for more people. Well, I'm not here to defend Joe Biden, but if Biden were responding to this, he would say, well, guess what, Jamie? What I would like to do is raise taxes on the wealthy and raise taxes on businesses and redistribute some of that to lower income groups. And of course, Jamie Dimon didn't endorse that either. So honestly, weak take by Jamie Dimon. Try harder, man.
30 seconds here, Rick. Do you anticipate an endorsement coming from Dimon anytime soon? And if so, what would be the catalyst for that?
Well, if he didn't do it here, what's he waiting for? It's well known Jamie Dimon leans Democratic, and yet he won't say what he obviously thinks, which is that Donald Trump would be bad for America. So Jamie Dimon thinks America's political leaders need to be more courageous. I think America's bankers need to be more courageous.
All right, Rick, great to speak with you as always. Thank you so much. And by the way, really important flag for you. We've got a new Charlie XCX song, so make sure you put that in the family group chat for the weekend. Thank you so much for joining us. We appreciate it. Coming up, Exxon and Chevron out with their latest earnings. We're going to dive deep into the outcome of both when we get back.
Chevron and Exxon both out with earnings this morning. It was a bit of a different picture when you take a look at the two stocks. Let's start off with Chevron. That missed on estimates due in part to smaller refining margins and tax benefit losses. Then when you take a look at Exxon, actually right now it's trading just below the flat line, but they actually beat on their earnings estimates here after posting record oil production at their Guyana and Permian Basin site. So here with more analysis, we want to bring in Brian Kessens. He is Tortoise Capital Advisors Senior Portfolio Manager. Thanks so much for joining us here, Brian. And I think when you take a look, at least in the headlines coming out of these two prints, it looks to me that Exxon's gap maybe over Chevron is widening a bit. But what's your read on the most recent quarter?
No, I think you hit it exactly right. Both from an earnings perspective, certainly that diverged this morning with Exxon exceeding estimates by a little over 10%, and Chevron actually missing estimates by actually a little over 10%. I think came in down 13%. I think as it relates to the production of both, you mentioned it. Exxon beat overall in their production, 4.4 million barrels per day versus 4.2 million that was expected. That's a pretty sizable beat. And not only did they beat, but it came through on kind of their three larger horses that they're betting on over the longer term as growth engines, that being their legacy Permian position. They just acquired Pioneer Natural Resources, And the synergies that are coming from that transaction appear to be coming to fruition. And then our Guyana asset also continues to perform. Whereas if you look at what Exxon or what Chevron indicated from a production perspective, they had some unplanned downtime in Australia, and some of their other international operations missed.
Sticking with Exxon, I'm just curious, how much more upside do you anticipate for the stock here?
Yeah, we really like what Exxon in particular is doing from a capital allocation perspective. We had anticipated that they would buy back about $3 billion worth of shares in just the second quarter. They upped that, exceeded that by about they came in at about $5 billion, and they've indicated that on an annual basis they want to buy $20 billion back in shares. Along with that, they continue to grow the dividend. From Exxon's perspective, we think that based on their production and their capital allocation framework, low double digits to mid-teens type of a total return is our expectation for the stock there.
Brian, comparing that to what you're seeing play out at Chevron, because we had some commentary from CEO Mike Wirth this morning. He remained very confident in the Hess deal, but when you take a look at the timeline of that, now it's pushed out here to the third quarter of 2025. What does that ultimately then do? How much pressure maybe could that potentially put on Chevron's business or challenge its ability to compete here with Exxon, at least over the coming quarters?
Yeah, it is a really big overhang for the Chevron stock. Hess obviously is a very material transaction. Not only that, but with Hess, they're trying to pick up another big growth engine, that being Guyana. And just the uncertainty of what ultimately happens with that until that arbitration hearing happens, a little less than a year from now, but next May is a long time for Chevron to be dealing with the Hess transaction. I think from a business perspective, they're best just to keep their head down, fight through and execute on their existing business, and try to put the Hess acquisition aside as they focus on that, and then obviously deal with it when it comes around next May.
Right before you came on, Shauna smartly pointed out that Chevron talked about moving its headquarters to Texas from California. Talk to me about how you kind of view that move, and again, what it could mean for Chevron, the stock, moving forward.
Yeah, it's probably a long time coming. Frankly, they did remain in California for a long period. They have gradually been building an office in Houston. In fact, I think today their Houston office actually has more employees than their Northern California office. So it's probably not any big surprise that they're making the move. Nearly most of the larger energy companies now are headquartered in Texas. So no surprise. And I generally think that'll be perceived pretty favorably from the investment community and investors making that move.
All right. Well, as you're looking at across your screen, still some negativity today, but interesting points moving forward there. Thank you so much, Brian, for joining us. Again, that was Brian Kessin, Senior Portfolio Manager and Managing Director at Tortoise Capital Advisors. Coming up here, we'll continue to monitor the market action that we were seeing on the heels of that jobs report. You're still looking at moves to the downside, the S&P down about 2.5% and the Nasdaq down over 3%. Stay tuned for more on that. You're watching Catalysts. Stocks still moving to the downside here. The Dow falling over 700 points. You've got the S&P 500 down nearly 2.5%, and the Nasdaq down nearly 3% here. The Nasdaq 100 heading towards its worst month of the year. Also taking a look at the VIX, the volatility index here. We're also seeing a spike in volatility after a record run of a lack of volatility, given some of the macroeconomic data we've seen and the tech earnings that we have seen over the past couple of weeks here. All of this coming after, of course, that weaker than expected jobs report. Joining us in studio to discuss, we've got Ann Maletti, the head of active equity at Allspring Global Investments. Ann, thank you so much for coming in studio with us. So we're obviously seeing a negative reaction off of that jobs print. I just want to get a sense of how you're viewing today's market action and the longevity that you think it's going to hold over this market.
Well, certainly we believe that volatility would increase because we're later into the election year cycle. There was a lot of question mark about, is the Fed going to lower, when they're going to lower, how much they're going to lower. That's in play. And we're also seeing, if you just look at the micro environment and company fundamentals, some deceleration of growth, particularly of those companies that really have been holding the high threshold for growth. And so volatility, we see it today. A lot of people get a little frightened when they see things like this. It can be a good thing to let some steam off because the market was pricing in perfection. And it was pretty clear that, even the attempt at a soft landing isn't easy.
So what does that tell us then about the downside pressure ahead? Because I think that's the big question, at least when you take a look at some of those tech names. They had been under severe amount of selling pressure here this week. It's been pretty volatile here when you take a look at some of the former leaders within that space. Do you see more selling ahead before we see a return in that momentum?
I think we're going to see a kind of a mixed bag. This has kind of been one of the most interesting quarters when you look at company fundamentals. I think the average stock move when companies report has been 5%, which is pretty dramatic relative to what we've seen over time. And so I think the market will continue to react to fundamentals, both good and bad. But when you see bad news, it's going to be bad news instead of bad news being good news, particularly as it relates to items within the economy. When you see weakness, there is real fear that the next risk isn't an inflation spike, it's that we're closer to a recession.
And it just changes so quickly, that narrative, to your exact point. If we'd gotten this unemployment print a year ago, it would have been, yay, the Fed is going to cut. Having said that, I want to pull up the Russell 2000 because it is under pressure alongside the other major indices today. I believe it is down over 3% here in the morning trade. You're looking at on your screen right now the movements that we've seen over the past 3 months, though. Having said that, what is your thinking on the pressure that we're seeing in small caps specifically? And do you think we'll get that rotation narrative that we got a taste of coming back in here?
I still think we'll see the broadening out of the market. And we have been signaling to investors it was time to kind of think away from just the pure concentration and look a little bit more down cap. Part of the reason that we were seeing that is, again, when you look at company fundamentals, people think about small cap in the Russell 2000 as the 40% of non-profitable companies, but there's a lot, 60% plus, that are profitable, that have good growth, and even more than that in the mid-cap space. And so underlying what you see, there are some really good companies that we're trading at huge discounts to the rest of the market. Even, you all talk about this a lot, but those top 5, 7 names and the multiples versus the average multiple of the market versus the equally weighted multiple of the market. There's big differences. And we believe that would start to squeeze. Now, the real question, I think from this point is, if those larger names continue to compress, can you get the smaller names to rise? And I think that's a little bit more difficult as the market kind of struggles through this. So we're focused on quality companies and making sure that investors are staying invested, but staying invested in companies that can live through what could be a much choppier cycle.
You mentioned earlier there, and just about volatility increasing here, especially as we head into the election cycle and election season. I guess, what would your advice for investors be in order, what that strategy maybe should look like surrounding the chances of higher volatility?
Yeah. It's a great question, and one that we get asked all the time. And I think the natural tendency of an investor is like, gosh, I gotta be right on my timing getting in, and I gotta be right on my timing getting out. Well, I can tell you, even professional investors are not experts at timing. And so what I've learned over my career is the compounding impact of staying invested in the equity markets is really, really important. And so again, just picking the area that you want to be invested in, and at this point in the cycle, making sure you're invested in quality, right? And so instead of playing the interest rate trade where you go, okay, I think small caps are going to rally, but that means I'm going to go toward the most levered name. We haven't been playing that game. We're playing we think the market could broaden out, but let's stay with quality because the macro world is pretty uncertain.
All right, Ann Maletti, great advice there for all of our viewers watching right now. We really appreciate you taking the time to join us here, especially on such a active, volatile day here for the markets this morning. All right, head of active equity at Allspring Global Investments. Thank you, Ann.
Coming up, new policies protecting home buyers and sellers coming into effect later this month. We're going to have the details for you, what you need to know on the other side.
Big changes are coming to the housing market. New real estate policies that are aimed to protect home buyers and sellers are coming into effect later this month. This comes after the National Association of Realtors settled a class action lawsuit earlier this spring. So for more on what buyers and sellers need to know, we've got Yahoo Finance senior legal reporter Alexis Keenan. Alexis, thanks for joining us on this. So, what exactly is happening here and how does it impact folks who are looking to get into the market?
Okay, so this is really consequential, this court decision, and it's going to usher in a really new era of home buying and selling for buyers, sellers, agents, and it's starting on August 17th. So there's just a couple of weeks that we want to give our viewers and our readers a chance to be ready for what to come and know their rights when it's time to buy or sell a home. So everybody's going to feel the impact of this monster decision. It came out of a jury in Missouri, and it ended in a settlement. So this is how it goes. It really shifts the negotiating power for agent commissions. These are the commissions that are paid to real estate estate agents on most home sales across the country. It's going to shift it away from the agents and put it in the hands of buyers and arguably sellers too. Now, the expectation is that this is not only going to drive down real estate commissions, but also maybe home prices. That was part of the argument. This is an antitrust case. So the sellers here, a class of sellers, were saying that this whole scheme was pushing up for decades the prices of homes across the country. Also, possibly, real estate services maybe become more of an a la carte offering here. So what buyers and sellers need to know about these changes is if their home is listed on the MLS, and that's about 90% of all homes sold in the U.S., the seller's agent is no longer going to be able to offer a commission to any other agents. The buyer agents, it used to be that they'd offer a split there on the MLS. They can't do that. And instead, they're going to have buyers agents are going to have to enter into a contract telling their clients exactly what they're going to pay. So that gives buyers a lot of negotiating power. The effect here is it really moves these negotiations out of the hands of agent to agent and puts it in the hands of buyers and sellers. Now, these new rules don't apply to every real estate agent, but a majority. And the reason is because it applies to realtors, and realtors are members of the National Association of Realtors. That's who was one of the major defendants in this case. And there are about 1.5 million real estate agents in the country. 1.4 million are realtors. So it's the lion's share of these folks. So it is absolutely going to change the way that homes are sold, possibly push down home prices, but that is yet to be seen. It's going to be a whole new era, a whole way of doing business in the real estate residential market.
It's a great breakdown, and you can catch Alexis's article coming up here on yahoofinance.com. Alexis, thanks so much for breaking that down for us. We'll keep right here on Yahoo Finance. Again, a sell-off underway here on the heels of that weaker than expected jobs print. Coming up next, we've got Wealth. It's dedicated to all of your personal finance needs. Brad Smith is in the driver's seat. He's got you for the next hour. We'll see you on Monday. Have a good weekend.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. On today's show, July's weaker than expected jobs print is further opening the door for the Fed to cut rates sooner rather than later. We'll talk to a financial analyst about what a rate cut means for your money. And attention all weekend home shoppers. Mortgage rates declined to their lowest level since early February, but are buyers actually acting on those lower rates? We'll break down the state of the housing market. And you won't want to miss this. We're speaking with three-time gold medalist Ali Raisman. Ali will be live from Paris, where we'll be closing out the first full week of the Olympic Games. We'll talk about Ali's journey navigating finances and wealth as a pro athlete. Can't wait for that discussion. All right, but first, before we get to that, stocks are lower after the July jobs report came in much weaker than expected. And that is causing a big reaction on Wall Street. You're seeing it play out right now. The Dow is down more than 2%, S&P 500 down 2.5%, and the Nasdaq is in the correction ballpark right now. It's down 3%. 68% of traders are now pricing in a 50 basis point rate cut in September. Just 1 week ago, that number was 11%, and just yesterday, 22%. So let's dig into the data here. Here with more, we've got Greg McBride, Chief Financial Analyst for Bankrate.com. Greg, we just got to start with the data that's really sent a shockwave through the markets here today. Why do you think that's so?
Well, you mentioned weaker than expected. It's certainly true when you look at the job growth numbers. It came in lighter than expected, downward revisions to previous months. But the really troubling details, Brad, were when you looked at the household survey, household side of the survey, we saw big increase in temporary workers that were laid off, notable increases in those that are working part-time but want a full-time job, those that are not in the labor force but want a job, and a reduction in hours worked, no matter how you sliced it. Those are unmistakable signs of a slowing economy. That's really what's got markets' attention today.
Do you think the market is overreacting here, Greg?
Markets do have a tendency to overreact, but we've seen a little prelude to this. The factory orders that came out this morning were bad. The manufacturing data came out yesterday was bad. The beige book that the Fed released a couple of weeks ago, that's what really, I think, raised initial alarms about, wait a minute, maybe this economy is a little softer than we think. So today's data really just kind of backs up that assertion. This doesn't necessarily come out of left field. So I think that coupled with, look at what we've seen in earnings. There's been a lot of disappointments on the earnings side and a lot of stock volatility. And I think all of that really kind of adds up to investors maybe taking a step back.
All right, we were perusing some of the tips that Bankrate.com has as well here. And we don't have to get into all 12 of the steps that people should take before the Fed starts cutting interest rates. But the high-level takeaways, what should people consider doing with their finances before the Fed starts to cut?
If you're on the borrower side of the equation, continue to pay down that debt aggressively. Interest rates took the elevator going up, but they're going to take the stairs coming down. So you can't sit back and wait and expect lower rates to be a windfall to you. That first rate cut's not going to be a panacea, even if it is a half-point cut. So continue to pay down that credit card, the home equity line of credit, those variable rate debts, and in particular, those high-cost debts. On the savings or investor side, beef up the emergency savings. And if you're a retiree or near retiree looking to lock in some interest income, grab those high-yielding CDs now, as in today, because those yields aren't going to get better by waiting. And by grabbing those now, you could still lock in yields that are inflation-beating returns over the course of the next several years. But the key is you got to be able to live without the money. You got to be able to lock that money up.
How does money affect when the Fed does cut rates? What ultimately is going to kind of really get impacted the most? What happens to people's money? What kind of changes will we see?
First and foremost, the most obvious impact is lower mortgage rates. Mortgage rates tend to lead what the Fed is doing, and we're seeing that even this morning. Mortgage rates will continue to fall. They've already fallen well below the 7% mark. And this is, I think, the beginning, because when the Fed cuts rates, it's not going to be a one and done. It's likely to be the start of a series of rate cuts over the course of the next year or so. And so expect mortgage rates to continue to trend lower. They will move in advance of Fed action, not in response. And that has a really big impact on affordability. Every half percentage point drop in mortgage rates, that's a difference of $100 a month for somebody who's looking for a $300,000 loan.
Greg McBride, Chief Financial Analyst for Bankrate.com. Greg, always a pleasure to grab some time with you. Thanks so much.
Thank you, Brad.
Certainly. The U.S. continues to lag behind other countries in closing the gender gap. America currently ranked 43rd in gender equality out of 146 countries, according to the World Economic Forum, also known as WEF. So, how long will it take to close the gender wage gap once and for all? And what steps are needed to make this happen? Here to weigh in, let's bring in Jana Rogers, Rutgers University economist and professor of labor studies and employment relations. So we're going to get to the how long of it, but what are the elements that need to be put into place in order for us to be taking the right steps along that pathway as well, Jana?
Hi, Brad. Nice to be here today. And the main cause of that really persistent gender wage gap is the motherhood penalty, where we are seeing women clustering into jobs that are more flexible or they're part-time, but they pay less. So I think three of the main things that need to change, first and foremost, is that we need to look at what's happening in the home and the distribution of care. And we need a more equitable distribution of that care and end that mommy stigma in the labor market. We also need to invest more in the care infrastructure. We're hearing a lot about infrastructure, but that also applies to care. Things like more affordable and high quality daycare, as well as paid parental leave. The U.S. is one of the only countries in the world that still does not have a federal law on paid parental leave. And also, speaking of infrastructure, we need more women in well-paying infrastructure jobs and other non-traditional jobs where women have not been represented, like jobs in the trades. They pay well, and there's not enough women there.
Jana, when we think about the fact that we're just a few years removed from a sweeping amount of companies announcing measures for diversity, equity, and inclusion, and that includes gender equity, especially as we're talking about women's advancement and making sure that we are closing this wage gap. Has there been any material move from what we've seen after all of those announcements were made?
I am a strong believer in these DEI programs, but unfortunately, they have been under attack in the last year or so. But yes, there's a lot of steps that employers can do, absent of federal changes in legislation, to advance women in their workplace. And some of these measures do start with effective diversity, equity, and inclusion policies. So they do work. They help to remove some of the stigmas and biases that are ever present in the workforce, but they have been under attack in the past year or so, and that needs to change.
And so let's go back to where we started this conversation, which was, beyond the things that will help close the gender wage gap. If we implement them successfully, what does a realistic timeline look like?
That is anybody's guess, especially because the division of care work in the home is so slow to change. Women are still doing the bulk of the care work, and that really is the main constraint that they're facing in their advancement in the labor market. So how long it will take for that to close is anyone's guess, but it does need to happen. Right now, the gender wage gap, the women's relative earnings, are about 84% for full-time workers. And that has been slow to budge for the last 20 years. but it needs to happen. And it's not just a women's issue. This matters for men too, because lifetime earnings are lower for women, and men's mothers, their sisters, their daughters, their wives, which means there's less money for their retirement, lower pensions, lower security, social security, and that affects everybody, not just women.
We're also, just lastly, while we have you, witnessing perhaps a great upskilling in the new wave of technology that a lot of employees or those who are participating in the labor force and trying to wrap their minds around, what things like generative AI, what robotics, what all of these things could mean for their future as an employee or part of the workforce, and trying to best position themselves to know how to work with that technology. How can that also add a competitive advantage for making sure that that is an element that helps close the gap as well?
Well, let's look at construction. I'm actually doing new research right now looking at AI and assistive robotic technologies and how things like exoskeletons may help to encourage more women to get those high-paying construction jobs. We often think of AI in the form of ChatGPT and other, technology that helps us in desk-oriented professional kind of jobs. But there are other jobs that pay well, where women are underrepresented, where we could look at AI for ways to improve their representation as well as retention. So I think there's a lot of potential for AI, and construction is just one example.
Really interesting. We'd love to see that research as well once fully finalized and published. Yana Rogers, thanks for giving us a preview into that. Rutgers University economist and professor of labor studies and employment relations. Appreciate the time.
Thank you, Brad. Nice to be here again.
Certainly. Thank you. Well, as we wrap up a big tech earnings week, it feels like all we've been hearing is the latest on AI investments, and companies are making big bets on the technology. But will it meet some of the lofty expectations? To discuss, let's bring in Yahoo Finance market domination anchor Julie Hyman. Hey, Julie.
Hey there, Brad. Basically, it has to.
Yes.
As I wrote in this morning's morning brief newsletter, when you look at the huge amounts that these companies are spending, basically these efforts have to succeed. It's almost, as my editor Ethan Wolf-Mann wrote, the AI spend is too big to fail. So much is riding on it. And just to put some numbers around it and what we've been hearing about this earnings season thus far, Meta raised its CapEx forecast for the year to $37 to $40 billion. Microsoft spent $19 billion last quarter. Amazon spent $30.5 billion in the first 6 months of the year. So just to give a few examples of those big spending numbers, Alphabet wasn't as clear about what it's spending and what it expects to get out of it. We've seen some of these companies get punished when it hasn't been as clear what the return on investment is going to be. Meta has been sort of the outlier in that, because the perception has been that they are seeing some fruits of their AI spend when it comes to advertising and other efforts on the platform. But you do have to worry about the sort of bias, if you will, Brad, from these companies. They'd say how much AI is transformational, and so they spend all this money on it. But then even if it doesn't turn out to be transformational, they're motivated to make it so, right? Because they've spent all this money. And there's still a lot of optimism within the industry. I mean, we talked to Patrick Moorhead the other day, who's a tech analyst, and he's still confident that even if it takes a little while, they'll figure out how best to optimize AI and what it's for.
Right, the pivot,
right? But it is, there are still a lot of questions, and there are some on the street who have been asking the question of, what are we going to get out of all of this?
Right. What is the return on investment, and how do we kind of see it in our everyday lives tangibly? And for investors, how do they really maximize on the shareholder value as a result of that? And does it take the amount of time that it took for Cisco to prove to the street that it could grow into its
Right.
valuations. And speaking of those valuations, we had talked about lofty valuations with Stacey Rasgon yesterday, and he was talking about the difference between lofty numbers and lofty valuations. Not all of these companies being, expensive, as he was looking at a company, a poster child, in Nvidia,
Yeah.
and saying it's actually quite a bit cheaper today than it was before the run started. But, it really comes back to, are the earnings actually achievable for
Yes.
what these companies are investing
Well,
in?
Nvidia, when you look at where they are in the different parts of the stack, of the AI stack, if you will, Nvidia is getting all that upfront investment. Then you have the cloud companies, the Amazons, the Alphabets, the Metas of the world, the Amazons of the world, who are then using the chips to build out all of that capacity. Right. Then there's the next wave question of enterprise software companies, right? A ServiceNow has talked about productivity gains, but they're going to be under more and more pressure to quantify that and to prove that they are getting those productivity gains and that it is adding to their business. Yeah. And if they're spending so much, there's going to be a real motivation to justify that spend. And I think investors and analysts need to take a real hard look at whether they're actually getting out of it what they say they are.
Yeah, excellent context, excellent breakdown. Julie, thanks so much for joining us here on Wealth. Appreciate it. Everyone, coming up, shares of Intel, my gosh, sinking today after the chip maker gave weaker than expected guidance and announced plans to slash 15,000 jobs. Our executive editor, Brian Sozzi, spoke with the CEO, Pat Gelsinger. We'll bring you that conversation right after the break.
Intel's latest earnings report, very much in focus, challenge quarter for the chip giant. I want to get right to Intel CEO Pat Gelsinger. Pat, good to see you as always. No matter what you report, I have to give you credit. Rain or shine, you're always here talking to Yahoo Finance after these results. We thank you for taking the time. I don't know how else to put this quarter. The stock is under a lot of pressure. Maybe we can go through this line by line. How much pressure is your business under right now?
Yeah. Hey, thanks, Sazi. Always a pleasure to chat with you. The quarter, we landed the top line within the range we said. We had the challenges with the China export, but the big news, of course, was the bottom line. And for that, it was very much, hey, we accelerated the AI PC, and that had lower margins as we moved into our next factory to accelerate the ramp of it, which was negative. And obviously some other one-time things that we referenced as well. It was much more the outlook, where it was a weaker outlook as well, as we expect some of those challenges to persist. And we made a major announcement about our structuring changes as we look to the future. So overall, a lot of great product and process milestones. I'll say phase one of the journey, it's just stunning what we've been able to accomplish. And now time to take pretty aggressive steps on the financially sustainable model for Intel for the future. And that's what we've rolled out. We're very committed to the journey that we're on.
What surprised you on the cost front as you went through the quarter?
Well, clearly, as we made this decision to move into our Ireland factory from our TD factory, had quite a large negative impact on our margins from where we indicated at the beginning of the quarter. This is the right thing to do, get into the production factory, accelerate the volume ramp of our AI PC components. But it was a surprise. And that and some of our own operational things, as we said, this new operating model, Intel Foundry, Intel products, we're not mature yet, and we're making the steps necessary, to mature that rapidly. And overall, as we'd say, the market was a little bit softer. Some of our cyclical businesses taking a bit longer to recovery. Some of the inventory digestion that we spoke about as well in areas like our client business. So I'll say all of those put together, moderated our outlook. And we're taking the steps for a more sustainably, financially effective Intel for the future. This is the biggest restructuring of Intel, I'd say, since the memory microprocessor decision 4 decades ago. We laid out the new operating model, and we're taking decisive steps to execute on the process and product work that we've done to now combine it with an operating model to make us effective for the long term.
The third quarter outlook, too, below consensus as well. What don't you see getting better quarter over quarter?
Overall, we see the market recovering more slowly than what we indicated at the beginning of the year. All of our cyclical businesses see improvement, but less so. And we've seen that in the auto industry, the FPGA business. Each one of them are recovering more slowly. We have some inventory in the client business that we have to work through. The data center business remains primarily driven by the AI build out. So the CPU portion, the Xeon portion of that is more modest. So I'll say everything is moving a bit more slowly in the second half of the year than we would have indicated earlier. But the overall trends, we see more positive in the fourth quarter. We see slightly above, normal growth rates in the fourth quarter. And clearly, as we go into next year, things like corporate refresh, AI PC accelerate, our product lines are stronger and our new AI accelerators start to ramp more effectively. So we're still optimistic for the long term, but we realize that the second half of the year, a bit more challenged than we would have indicated.
Is this a market issue or a product issue, Pat?
We see no market share changes than we felt at the beginning of the year. So we'd say every one of the things that I just said are market effects in that regard. We see no meaningful change in our market share position. Now, obviously, areas like AI have driven the discussion on where the investments in data center and cloud go. So even as our products get to be stronger in those areas and we've launched our new products, the overall market conditions are ones that we haven't found as much momentum as we would have hoped. So each one of these is a market condition. And as we get stronger over time, we'll be better positioned to start regaining share in some areas like data center and accelerators and continue the strong growth in our areas like AI PC. Of course, we have to also say about the foundry And we're seeing good momentum in areas like our advanced packaging area of that business. The 18A PDK release, this is sort of the starting gun for people to start their production designs. And so we're seeing a lot of energy in that area. But overall, market conditions a little bit more modest. And I think outside of the AI sector, you've seen that in multiple announcements.
Pat, you know I've followed your journey at Intel from day one. I've followed Intel for a long time. To be frank, I was surprised by the dividend cut and the CapEx cuts for this year and next year. Now, there's a lot of people in this country rooting for your comeback to be that beacon of hope to make chips in the country. But how do you, I guess, quiet their concerns that Intel is running out of time to turn itself around and it won't be that beacon of hope to make chips in the country?
So, as we laid out our overall projects in the U.S. and the CHIPS agreements, they're all milestone-based, and we're comfortably inside of the milestones that we have. So our plan to build out U.S. manufacturing unchanged. We continue to see great momentum with U.S. government, CHIPS program office, many areas as that unique national champion, and many of those things are seeing very good progress in those areas. So no change in those plans. The CapEx reductions are very much focused on building a more efficient Intel. And we've made many of the catch-up investments. We radically increased our capital expansion and capital investments over the last several years since I came back. We had no shell capacity, no site capacity. We had to catch up on our process technology. So all of those investments are ones that we can now build on as we build an efficient, effective foundry. And foundries manage their capital investment very carefully. And as we have laid out this new operating model of Intel Products and Intel Foundry, we should be scrutinizing those capital investments carefully. And that's the decisions that we're making as we do those. And some of that adjustment is just based on market conditions as well, where we see the growth rates in the marketplaces. So we would say our strategy is unchanged. We remain committed to being that world-class foundry, stepping into that space for a resilient supply chain for the world. Our plans for our build-outs, our CHIPS investments, no change in those, even as we make these near-term adjustments to be a more efficient supplier for the future.
You mentioned the headcount reduction, Pat. 15%, that's a large number, 16,000 people. How concerned are you that that reduction will impact the culture of Intel and then slow up the turnaround at the company?
Given that we've now, gotten our process and product in place, we feel like we're in a position that we can make these next steps. We are doing that clean sheet work of what a world-class foundry looks like, what a world-class fabless company looks like. And those efforts to clean sheet the company are showing that we have many areas of inefficiency. We were still built like a IDM 1.0, as we've said, this integrated company. So being able to separate those and look at best-in-class companies has identified many of those inefficiencies. So I need to change the culture to be focused in those areas, and these steps are consistent with that, building on the momentum of the last 3 years. They're also surgical. We're looking business by business, function by function. What do we do in G&A and sales? How do we do our development? What's the best in class in the industry for each one of those? Which business areas do I need to go up? Which business areas am I over-invested in? So we'd say all of this is healthy for a sustainable Intel for the long term, even though it's challenging in the near term and something we don't consider this, modestly. We consider this very seriously. These are members of the Intel family. We're going to treat them with dignity and respect, even as we go through these changes.
We always appreciate you stepping into the hot seat. I know these are not easy decisions. Pat Gelsinger, Intel CEO. Good luck this quarter. We'll talk to you soon.
Thank you.
All right, much more ahead on Yahoo Finance. Stick around.
The market sell-off is escalating after that weaker than expected July jobs report, fueling more concerns around the possibility of recession. Yahoo Finance's Jared Blickery is here for a deeper look into this market action here. Jared, what are some the key levels that we're breaking through right now?
Let's start with the S&P 500, which is now having its worst day since late 2022. And I'll show you the intraday chart. And we are probing new lows within the last 10, 15 minutes here. It's all came after that 8:30 a.m. report this morning, the jobs report, which disproportionately is now affecting the Russell 2000 small caps. And in fact, let's just kind of show the 5-day price action this week. It's been pretty volatile and easy to forget. We had a nice upside day on Wednesday, but over the last 2 days have definitely lost about most of the week's gains, or most of the selling in the week has occurred in the last 2 days, down 7%. Really interesting to track what's happening in the Nasdaq and the Nasdaq 100 as well. We're 2 days into August, and Nasdaq 100 is already having its worst month of the year. You can see still holding on to gains of 9%, but now basically reaching a prior resistance level. So I would say the Nasdaq 100 kind of at the Rubicon here. And I also want to plot the 200-day moving average on the S&P 500. Now that is some ways down, so we got some space, some room there. But just take a look at what's happening with the VIX, and then I'll get into some heat maps. This is the highest level that we've seen in the VIX since 2022. And let me just show you in relation. This was a huge bear market, so the fact that we're already climbing up to some of these levels, I think, is instructive. Take a look at the 10-year T-note yield. On a year-to-date basis, it has now gone negative for the year. Over the last 2 days, it's giving up something like 25 basis points, just really pricing in a lot more conservatism. And these rate cuts that everybody's expecting from the Fed, rate cuts are great, but not if you're heading into a recession. And unfortunately, we just triggered the Sahm rule. So a lot of nastiness to digest today on the returns front.
All right, Jared, thanks so much for that check-in and some of the key stats, especially as we've struck 2 hours into today's trading session, 3 hours after that jobs report really wreaked havoc here. All right, we'll continue to track that for you and keep tabs and give you some updates. Switching gears, though, if you live in New York City, like myself, you may have noticed some changes on some of your food delivery apps over the last few months, as it's gotten a little bit more complicated to tip your delivery driver. Those changes came in April after the new minimum wage for delivery drivers in the city went up to $19.56 per hour, excluding tips. So, how have these wages helped or hurt drivers so far? For more, let's welcome in Lihia Walpa, who is the Workers' Justice Project Executive Director and Los Deliveristas Unidos co-founder. Thanks so much for taking the time here with us.
Thank you for inviting me.
Absolutely. Now let's talk about these changes. I mean, you've got a pulse of some of the people who are working in the gig economy and trying to make sure that they can make ends meet, but they're also experiencing this shift. How's this impacting them?
Yeah, so first of all, we should talk that we're talking about 65,000 New Yorkers, wow. Essential workers who do this work, and 77% of these workers actually do this work as full-time jobs. So since minimum pay, there has been significant changes. One is we have guaranteed that workers are guaranteed a minimum wage of $19.56. And since the minimum pay implementation, that has brought about $16 million weekly more in income. And something that we have also secured is to make sure that there is more safety on the road and making sure that workers prioritize their safety and they can still make a living in the city of New York, which is one of the most expensive cities to live in.
How has this impacted the amount of tipping that they see come through as well?
Yeah, and something that we have seen is how multi-billion-dollar app companies, instead of trying to be good business players in the industry, instead of trying to do the right thing, they have retaliated. And one of the things that they have done is they have completely removed the tipping option, significantly hurting workers as well, and significantly reducing the tipping income that workers need, especially during the summer, which is the slowest season for delivery workers. And they have intentionally done that to significantly hurt workers and continue to incentivize unsafe driving and unsafe, business practices.
When you think about the involvement or the amount of trips or the amount of deliveries that the workers are really considering makes sense in terms of the payoff for what they're getting per hour versus, a week period like this where they might even hop between apps. How are they going about that juggling act, that balancing as well, knowing that what you just mentioned, I actually heard it when I was discussing with one of the drivers who I had the opportunity to ride with the other day, saying that if they're not on the app for an extended period of time, they might get kicked off. So how is that juggling act being going for these drivers and workers?
Yeah, something we have where, the fight is not over. There is much more to do. One of the things that we can share is that workers are definitely making more and more. And our data and even DCWP data, which is the Department of Consumer Affairs, have showed that workers were making about $5. They have gone from $5 to $19 an hour. That's a significant change. Yeah. Unfortunately, the hourly paid, it only covers from the time that they're actively working. When they're not actively working, they're just sitting on the road waiting for that delivery, that time is still not compensated. This is why tipping is so important, and this is why we're also working through a second package of legislation that mandates offering the tip option to consumers at the beginning, because tipping continues to be a critical part of workers' income, especially when their payment for their waiting time, that means that when they're road being available to work, they're not being fully compensated. And the other one that we're actively fighting is against unfair deactivation, which equals to firing. Workers being penalized because they decide not to drive fast or take unsafe driving when they're doing these deliveries. And what we're seeing, how these companies are retaliating and putting more pressure on workers to do this delivery faster so they can pay less.
Absolutely. Lihia Walpa, who is the Workers' Justice Project Executive Director and Los Deliveristas Unidos co-founder, thank you so much for taking the time.
No, thank you for inviting me.
Absolutely. Appreciate it.
Yeah.
Everyone, mortgage rates ticking lower this week. We break down what you need to know if you're in the market for a new home on the other side. Stick around. As we watch Olympic athletes reach incredible heights, swim fantastic lengths, and score impossible goals, we can't help but be in awe. But when it comes to personal finance, there's still some challenges for athletes out there. Joining me now to discuss navigating personal finances and building wealth as an athlete, a woman who needs no introduction, but I'll give her one anyway, two-time Olympic gymnast and team captain. She has 3 Olympic gold medals, 2 silver and a bronze. She's also the author of the new book, From My Head to My Toes. It's Ali Raisman. Ali, thanks so much for taking the time here with us on Yahoo Finance.
Thank you so much for having me. So excited to be on.
Absolutely. Ali, let's just jump right into it here. I mean, we've been watching, spectating, and a lot of us wondering, especially here at Yahoo Finance, the second the spotlights, all of the stages and all of the rafters start to come down after the Olympics, it really becomes crunch time for a lot of athletes too, trying to figure out how to make that fame and make that moment in the spotlight really stretch. You know, how did you go about doing this successfully, and some tips that you would give to other athletes who are competing on this stage this year?
Yeah, I think what's really unique about being an Olympic athlete is for most of the sports, people tune in once every 4 years, and it's really hard to capitalize on that time because you're trying to figure out what deals to do, how to surround yourself with the right people. But I think I've been very fortunate where I have a really great support system, and I recognize a lot of people don't have that. So I have a really great family. I feel really blessed. And then I have a really great agency and a really great team that I've been with since I was 17 years old. And I think what I've learned is the most important thing is really being authentic to who I am, because I think this day and age with social media, the fans, rightfully so, are demanding more from us. They can tell if we're promoting something that we don't care about. And so that's something that I think about a lot. And I really try to stay true to my values and align myself with people and brands that I actually use and things that I actually care about.
That's a really great point, especially when you have so many young athletes that are coming into these brand partnership opportunities earlier on, and they're perhaps going into college or even still in high school, and companies approaching them saying, hey, it looks like you've got a bright future ahead. How would you like to help sell our cereal or something like that? And they're trying to figure out, well, do I actually align with this company? You know, what is kind of the checklist that you have to mentally go through when you're figuring out which company you want to work with?
Yeah, that's a great question. And it's something that I feel very grateful. I've had so much experience since the age of 17 years old. I've been working with brands, and I'm just turned 30. So I feel like I've learned so much over the years, but I've kind of learned that it's so important to not be afraid to ask questions. And, you know, if I'm with a CMO or somebody who's in sales or someone, you know, if I'm lucky enough to get to chat with the CEO, I try to ask them as many questions. And I know sometimes asking questions can be overwhelming, but I kind of just told myself that I'm not going to be embarrassed to ask questions. I'm going to learn more. And so I think that way is a really good pulse to kind of figure out what their goals are, what their visions are. And then I really try to have some philanthropy component to any brand that I'm working with, is it's not just selling a product, it's what's the messaging behind it and what are we actually putting out there. And it's great because I think a lot of brands are really passionate about mental health. And so I try to do a lot of stuff like that, whether it's mental health, abuse prevention, body positivity, things that align with what feels right to me. And I feel like the brands that are receptive are usually the ones that end up reaching out. And it's been a really wonderful, and I've learned so much over the years, and I've been able to craft very long-term relationships, which is also something that's important to me.
You've got the relationships on the business side. You've got your book that's out as well. I mean, we're talking about streams of income here. So when you're really thinking across your overall holistic kind of division of your time, but also how you're making sure that you're generating wealth and building on that, are there any particular industries or ventures that really excite you right now about investing in the future?
Yeah, I'm very passionate about financial literacy. It's something that is so important to me. I think the topic of finances is so uncomfortable for so many people. And the reality is most people are not comfortable talking about it. And most people aren't comfortable asking questions about it. And so I am really trying to figure out what this next chapter looks like for me. And I really want to do more in the financial literacy space. I actually think mental health and financial literacy are correlated, because if you don't have confidence in yourself, how do we expect people to feel comfortable asking questions? And I want to empower the younger generation when they're in school to not feel embarrassed to ask a question, whether it's in math class or anything. And I think about this a lot when I talk to brands, because especially in the world of Instagram where everything can be so filtered and kind of seem fake, I really want to be real and authentic to myself, but also for my own personal portfolio, I feel really fulfilled, and it makes me feel intelligent and smart when I feel empowered to ask questions. So I also try to surround myself with people, whether it's in finance or somewhere else, that make me feel comfortable asking questions and will go through it and explain it to me. So I think about that a lot as well. But with my own portfolio, I've recently gotten into the venture capital world of investing small check sizes in companies that I believe in. I'm very passionate about women's health space. And because I'm not a doctor, I try to really lean on different experts, and I love learning, and it's been so fun.
I was just about to ask you something along those lines. Considering some of the investments that have been made public from your side and really focused around healthcare and mental health as well, I mean, that's a theme that's run throughout the women's gymnastics team. We've heard that Simone Biles even checking in with her therapist prior to some of the competitions over the course of this year too. I mean, could we see like a gold medal ventures or something like that among some of the Olympians like yourself and former teammates come about?
Maybe. I think that would be really cool. I think it's really great how so many athletes we're lucky to have access to a lot of really interesting deal flow and a lot of interesting opportunities. So I love to see so many different athletes getting into investing, and I feel really grateful that I'm able to learn so much from people who are so intelligent and so smart, have different expertises. I sort of took the last several years to do a lot of calls with founders, and I feel so lucky to have their time, because I know they're so busy and they're doing so much and their job seems so stressful. But I feel so lucky that I kind of told myself I'm not going to be embarrassed about asking a question. There's no such thing as a dumb question. I'm sure they've heard it all before. And I just sort of started getting meetings with them, asking questions, and I've learned a lot, but I still have so much to learn. But my brother's trying to get me to start a venture fund, so he would really like me to, because he's in the space as well. So maybe one day, but I don't like to start anything unless I'm like 100% confident that I can do it. So I want to wait until I feel more comfortable and I have more time to learn and I get the right team around me.
All right,
so maybe one day. Not right now.
You come back here when you're ready to make that announcement, Ali. We'll welcome with open arms. We're ready to have that conversation in the future, too. More than an athlete, two-time Olympian, Ali Raisman. Thanks so much for taking the time.
Thank you for having me.
Certainly. Everyone, coming up, we've got more Yahoo Finance on the other side of this short break. Stick around. We've got some good news for home buyers. Mortgage rates dropping to their lowest level since early February, according to Freddie Mac. This comes as the Federal Reserve set the stage for a September rate cut. To discuss, we've got Yahoo Finance's very own Danny Romero with more. Hey, Danny.
Brad, you're right. Good news for potential home buyers. The mortgage rates are moving lower. The average rate on a 30-year fixed mortgage fell to 6.73% as of Thursday, August 1st. That's what Freddie Mac reported. Now, this is lower than a year ago when the average rate on a 30-year fixed rate was around 6.9%. Now, this does come after the Federal Reserve held interest rates steady, but hinted that the central bank could cut interest rates next month, which in turn could trigger mortgage rates to fall. Remember, the Federal Reserve doesn't set mortgage rates, but its policy moves consequently impact borrowing costs. Now, despite mortgage rates moving lower, many are still waiting on the sidelines for rates to fall even further. Pending home sales, a forward-looking indicator of home sales based on contract signings, fell 5.7% on a yearly basis, according to Redfin. And one of the reasons for the weaker sales is the lack of desirable listings. Nearly 2/3 of homes for sale have been sitting on the market for at least 30 days without going into contract. So looking ahead, some housing industry experts expect that in the next few weeks, the 30-year fixed mortgage rate could fall around 6.5% or even lower on the heels of the latest jobs report showing weaker job growth and rising unemployment. Brad?
All right, Danny, some key stats there to keep tabs on. We're going to see what the pulse of those potential home buyers are looking like going forward from here. Appreciate it, Danny. Well, the market sell-off that we're seeing following the weaker than expected jobs print sending the Dow lower, over 800 points right now. The S&P 500 and the Nasdaq also dropping precipitously. The S&P 500's worst day since 2022. For more on this, we're joined by Scott Ladner, who is the Chief Investment Officer over at Horizon Investments. Scott, thanks so much for joining us here. What should investors do during a sell-off like this?
Hey, Brad, thanks for having me. Look, what investors should do right now is probably take a little bit of a breath. It has been a pretty solid run up for most of this year. The last couple of weeks have been challenging, obviously. First led by some somewhat disappointing earnings numbers, and then the economic numbers we've gotten over the last week have sort of challenged the thesis of a kind of robust and strong labor market in the United States. But at the end of the day, we got to remember where we are. We're still, this is still an economy that's incredibly, coming from an incredibly strong spot, a consumer that's not levered at all in a really strong spot, and corporations which are making money hand over fist in general. So this is probably a time to take a little bit of a breath. This is largely a positioning driven and sort of a technical driven unwind that we're seeing right now, but it could definitely go on for another couple of weeks.
I mean, when we've heard of some of the more bullish folks out there saying, hey, buy on the dips. I mean, this seems like the dip and the dippity dip as well on top of that. So what should the mindset be for those who are trying to make sure that they're strategically picking parts of the market that are sustainable enough for them to see opportunity right now and perhaps get in?
Yeah, look, I think as everything else, it comes down to your investment horizon. If you need money in the next few weeks, just got to stay out because this is just too uncertain right now. The kind of moves we're seeing in the market right now are generally categorized as unhinged. There's things going on in the market structure that's a little bit goofy right now. So that can lead to more goofiness, to be completely technical about it. But if you have an investment horizon of 3 to 6 months or longer, which is most people, this is probably a viable dip. But again, I just caution, this is what we're seeing today and what we've seen yesterday is some somewhat unhinged behavior. And we can see further declines from here. So I wouldn't go kind of all in buying this dip, but you can definitely start nibbling here, especially in the tech space.
When we think about the potential rate cuts coming forward, I mean, we're now seeing the CME FedWatch probability look at potential 50 basis point cut in September. I mean, the probability of that jumping just compared to 2 days ago and even yesterday. So when we think about that, how at Horizon are you thinking about a differentiation in strategy in terms of a rate cut playbook, if you will?
Yeah, I mean, we've seen this playbook change a lot, obviously, over the last couple of days. And right now, we're seeing between 4 and 5 rate cuts being priced in before the end of the year. That's very different even from like a couple of days ago, Brad. And so, the playbook from here needs to be, again, probably start buying some of these tech names, probably, kind of double down on some of the energy and some of the utility names if you've got some of those. This is, we think, going to be a viable dip, but this is like, a dip that you probably, allocate 10 to 15% of your dip buying capital, so to speak, on a day like this, and probably try to just leg into it over the next few weeks. Because again, we think it's going to be highly volatile, and this is a little bit unstructured right now. But the medium-term fundamentals of both the economy, the consumer, and corporations is really fairly unchanged over the last 2 days. But we are seeing a recession trade being priced in, and that's just a train you can't get in front of with both feet to start.
Really appreciate you taking the time here with us today and breaking down some of this market activity for us. We got to continue the conversation in the future. We got to leave things there for right now, though. Appreciate it.
Thanks, Brad.
Thanks. That's it for Wealth, everyone. I'm Brad Smith. Thanks so much for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. They'll count you down and through the market close. You don't want to miss it.